be an overlap for some time between the normal fees and the corporate tax until we know the basis and the foundation, and these things will be left out. So it's going to be taking some time until things are going to be balanced. It's the first time we're applying it. It's going to take some time. The good thing about it is that we're not going to apply the corporate tax on anything big differentiation between locals, residents, and the one who wants to live in the country, and that's why it's part of our welcoming signature one. The UAE is a center to do your business and to grow from the UAE.
Let's just close off on the tax, because I come from Ireland, and they made hay with their corporate tax reduction. Taxes are rising in Europe and in the West. Here you are at 9% corporate tax. How important is it that is continuity, that's not going to ratchet continually upwards? Taxes rarely go down, Minister, as you know. What is the message on tax continuity? If I look at the EU at 22%, globally 23.5%, you're 9%. Message to the market on tax continuity?
We're always going to be an attractive hub and center destination to all businesses, as low as possible when it comes to taxes.
I want to flesh some of the key themes out with Athira Prasad, the macroeconomics director at NASA Society and Associates. Athira, on the diversification of trade flows front, what would success look like over the next 6 to 12 months?
Well, this is a good start, right? For the UAE, COVID has changed many things, including their push to accelerate the reforms that were already being planned. So one of the key ones that we've seen is, of course, trade. So trade and investment agreements with a lot of emerging markets. The bigger one of them is India, of course, because they are the second largest trade partner for the UAE, and the plan is to increase trade to some $100 billion in the next 5 years. So it's not surprising that the UAE is taking more steps to kind of enforce that, more and more trade agreements are there in the pipeline, which see a final step of actually signing the agreement. We know from the past that, including the trade agreement with China, it's been in discussions for a really long time, but nothing has come through so far. So UAE is taking a step to go ahead with bilateral agreements, and it's both on the trade and investment side. So it is going to work out in a very good way for the UAE and for the other countries.
All right, so a lot of positive takeaways as far as you're concerned, Athira, and that may be admirable, but that's sort of where you come in. What could they do more of? Where do you see a front for improvement?
Well, I think the diversification push is something that needs to happen quite significantly. Now, Dubai as such is not as reliant on oil as the UAE in general, because what you've seen is the diversification efforts that had taken place pre-COVID were in sectors that got the most hit by COVID. So you have trade, you have logistics, you have hotel accommodation, and so on. So the diversification needs to happen in other sectors a lot more. So we are seeing signs of that taking place. You're seeing a significant push towards manufacturing products from Abu Dhabi especially. You're also seeing new up-and-coming sectors, fintech being given an extreme push. You're seeing people talk of crypto firms being established in the UAE. There was a news piece that DMCC has a crypto hub, which is more than 500 that people who are working in that area is ready to come and live and work in Dubai. So, yeah, all positive.
What about the crude oil markets, where much of the momentum is being generated from? It's been a huge windfall for the UAE, for Saudi Arabia. When you look at some of the price caps, when you look at the supply and demand at the moment, where do you think that leaves us for the remainder of the year?
Oil markets this year, what we've seen is the year last year ended with China deciding to reopen, which will give a big push on the demand side. Already, if you look at some of the numbers being quoted, you're saying that in China, road congestion has gone up by some 22% just this year. So that, and if you look at the people who are traveling across the country during the Lunar New Year period, you are bound to see a significant increase once they are back at work. From their home regions. So all in all, China's consumer demand is going to rise for oil, and that would work very well for oil prices in the near term. Add to that the Fed's policy, potentially smaller rate hikes. All that adds up to a good year for oil prices.
Okay. So quite a bit more momentum to come than to the upside. Athira, in terms of wheat prices and the cost of living crisis, specifically those who can't even afford very basic goods, food to eat, for example. I'm thinking of Egypt. To what extent is there significant stress in the system that it might lead to broader ramifications in the short term?
Egypt is a difficult case because they've just seen inflation rise to a 5-year high. But the government is trying to put in measures wherein it is trying to reduce the cost of living pressure. But it remains to be seen how good or how effective it is going to be, because now you have last week being announced that even those who are not on the bread subsidy program can go ahead and buy bread at lower costs. But a significant share of the population is already at the poor level, and it becomes increasingly difficult for them because what you're talking of is price increases in essential commodities. So it affects them more than it would affect some of the richer sections of the country. So it is going to be a few difficult years. Hopefully the IMF push in terms of more reforms is going to benefit the country in a positive way, but it will take time before things go back to normal.
Yeah, and then we hope to get more clarity on the currency front as well, where there is still a gap between forwards and the local Egyptian pound. Athira, thank you very much. Great to catch up. That's Athira Prasad, the Macroeconomics Director of Nasa Saidi and Associates. I want to get you a couple of breaking lines leading to Bloomberg on one of the largest airlines in the world, Emirates. They are going to restart the service to Christchurch via Sydney. That's going to happen in March. They're going to raise service to Sydney and to Melbourne, which is another major step in bolstering capacity to Australia. And that, of course, goes to show that this is becoming more of a priority in the broader set of destinations. Last week, you'll recall, we had the reintroduction of destinations between Dubai and China. Specifically Shanghai and Beijing, so we will wait to see what more comes from the airline over the next.
This is the Lexus variety of electrification, inspired by, created for, and powered by you.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Savannah.
Welcome to Bloomberg Markets trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Prime Minister Benjamin Netanyahu has fired a key ally from the cabinet in an early test to his coalition. And then on Saturday, more than 120,000 people took to the streets in Tel Aviv to protest his government's plans. So Foxman is watching all these developments. So Simone, what's the state of play for his government now?
Well, Yusuf, we went into the weekend wondering if Benjamin Netanyahu would respect a decision by the country's Supreme Court that Aryeh Deri, the leader of the second largest group in Netanyahu's coalition, couldn't serve in a cabinet role because he was convicted of tax fraud last year and is serving a suspended sentence. It does appear that Netanyahu has respected that decision. Had he not, that would have set off a constitutional crisis. But now the question is, do members of his coalition resign over this decision? At the moment, they don't seem to be doing so. This coalition seems to be sticking pat. But this is not the end of a potential war between Bibi's government and the judiciary. That's what people were out in Tel Aviv and to a smaller degree in other cities around the country protesting. And while markets have been willing to allow a certain degree of political instability in Israel, they've gotten kind of used to it. We did see researchers, including a former Bank of Israel governor, come out and say, if you quell the power of the judiciary, if you make it less independent, as Netanyahu's government wants to do, you could potentially impact Israel's credit rating. They point to experiences in Poland, Hungary, and Turkey as a warning to the government that investors will see less respect for property and contractual rights if the judiciary is less independent.
And then in other political controversies, the burning of a Quran in Sweden has set off outage. What is the fallout?
Yeah, again, adding to a dispute between Sweden and Turkey that's already been festering over Sweden's desired NATO ascension. So essentially what happened over the weekend was that a Danish-Swedish far-right activist burned a Quran actually in front of the Turkish embassy. Turkey extremely critical that that was allowed to go ahead, as were other governments across this region, including Qatar, Saudi Arabia, and the like. Swedish politicians say this is an expression of free speech. We kind of have to let these things happen, but obviously a lot of outrage there. Just another moment here that we're seeing in this conflict between the two countries about whether or not Turkey will allow Sweden to move forward with its NATO ascension. This is going to be another in a series, a long list of Turkey's dislikes here, and we are likely to see this issue escalate ahead of elections now confirmed in Turkey, parliamentary presidential elections for May 14th.
There have been a lot of changes in Formula One, and the Saudi Sovereign Wealth Fund, the PIF, apparently considered to buy Formula One. That's according to sources that have spoken to Bloomberg. How close did it actually get? I mean, we're talking about, what, $20 billion? Was that what the valuation was?
Or even more, and this really fell apart in the early stages. And frankly, it was because Liberty Media Corp, owned by John Malone, they just didn't want to sell this asset. But that's an enormous valuation for an asset that they bought at about a fifth of that cost back in 2017. Stock that tracks Liberty Media moved sharply higher on Friday when this news was reported, but that, even a premium there, it's more than about $15 billion before that news broke. No, but this deal didn't go through, of course, but let's not forget it. Let's keep it in mind. First off, because Formula One is going to Saudi Arabia this year, there's going to be events held across the Middle East region, but also because our sources tell Bloomberg that PIF's still interested. If this asset were ever to be on the block, they would be a strong bidder, according to sources, Yusuf.
Yep, Simone, thanks for that. That's Simone Foxman, kind of Financial Center in Doha. We still have much more ground to cover on Daybreak Links. This is Bloomberg.
This is the Lexus Ride Electrification. Inspired by, created for, and powered by you.
think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Let's get back to Middle East markets with our equity specialist Farah al-Bahrawi. So Farah, some ratings changes at Morgan Stanley for Saudi Arabia. What are some of the details?
Yes, this was a note focused on lenders, Yusuf, that came out on Friday. They initiated coverage on Arab National Bank at equal weight. They actually do think that lending will grow for the bank, especially driven by the corporate lending growth in Saudi Arabia. They think that it's going to grow 10% in 2023 from the year before, considering how strong it has been throughout 2022. And they do expect strong results on the fourth quarter for that bank. Looking at Arashi Bank, which is, of course, the largest lender in Saudi Arabia, they did upgrade the lender to equal weight from underweight, because its shares underperformed quite a bit in 2022 after a massive rally, 100% rally if I'm not mistaken, in 2021, and they don't see a lot of further downside for that lender moving forward.
From the ratings agencies, not ratings agencies, from the ratings to the IPO pipeline, what updates do we have there?
Yes, so I actually looked at this very interesting note from Camco in Kuwait. They said that the IPO pipeline remains quite deep, Yusuf. That's from 29 companies to 37 companies planned or are rumored to list. They expect the IPO market to continue to be resilient despite volatility from the oil market, and as well as just on the secondary market in general. They think that investors will continue to look for idiosyncratic names as well as smaller family offices, for example. And the key thing will continue to be dividends, of course. We saw utilities and consumer names really excelling on that front last year. So we'll monitor how that goes this year. We've had quite a bit of different news.
The bar is always a little bit higher for news flow out of Oman just because things are smaller there, but sometimes they're still key to discuss.
Yes, so Oman is trying to join that IPO push that we're discussing. We actually found out over the weekend that OQ is trying to list 49% or as much as 49% of Abraj. This is, of course, the energy firm in Oman, and that listing could fetch as much as $500 million, Yusuf. Not massive as the billions we've been getting from Saudi Arabia and the United Arab Emirates, but still quite significant. There's EFG Hermes on that IPO, as well as Ahli Bank of Oman, as well as National Bank of Oman, a key one to watch out for.
All right, we'll keep all of that in mind. Farah, thank you for the moment. That's Farah al-Bahrawi there. I want to take you to equity futures as we help you calibrate for this Monday with the absence of liquidity in Asia, because we have holidays in China, Hong Kong, Singapore, South Korea, Indonesia, among others. On the S&P 500, many were called lower by 0.1%. There is a continuation of earnings season, so I would put Baker Hughes at the top of your radar over the next few hours. I want to flip the board as well, because the other side of the equation in treasuries is really a growing concern that the bond market has written off the inflation risk too far. And so that could come back to bite investors later on in the second quarter at the US 10s, 346.59. Let's also talk about the energy equation, Brent and WTI. We are seeing quite a bit of, range trading with downside of 0.3%. Brent at $87.39 a barrel. Clearly, the IEA report gave investors a lot to work with in the last week. How is this going to change this week, given the focus on economic data, but also on what a recession could look like?
This is the Lexus Variety of Electrification, inspired by, created for, and powered by you.
wasn't getting enough blood to my head. I was so dizzy all the time.
More than 200 symptoms are attributed to long COVID, including exhaustion, rapid heart rate, and other bewildering symptoms. It affects 140 million people around the world. Lisa is one of them.
I couldn't work my job as a physician. I couldn't really be a mom. So it was a big change to go from defining yourself as a doctor and a mom to not having either of those define you anymore.
Harvard economist David Cutler puts the cost of long COVID at $3.7 trillion in the US alone.
Long COVID is likely multiple different diseases under the same umbrella. And if we bunch everything together, it's too complex. And so we can't even identify the right patients for right therapy.
We've done a remarkable job at developing vaccines in record time. We need to learn from that success, and replicate that success in the long COVID research arena.
We've only just begun to scratch the surface on understanding COVID's lasting effects. What's clear already is that the consequences of this viral disease will be vast and enduring unless scientists find ways to mitigate them.
London is in for Washington, Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Here's what I want you do not want to miss this story. The kind of upside.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Mpatswe, our top stories this morning. Since trading volumes with much of Asia off for the Lunar New Year, a good fresh data due this week boosts hopes that the global economy can avoid a major slump. The leaders of France, Germany warned that European businesses will need to unleash investments on a massive scale to keep up with US and Chinese firms. President Biden's lawyers say the Justice Department has found 6 items containing classified information during a search of the American leader's home in Delaware. We'll have the latest. And the UAE's foreign trade minister tells us he's hopeful of no major global recession in 2023, and that the Emirates will have a strong year. Here are our interview with Thani bin Ahmed Zayudi. Scandinavia across Emirates, I'm given in Dubai minus Cranny is off. We have quite a bit of absent liquidity in markets in Asia that is leading to subdued trading. On the S&P 500, we need to get you situated on this Monday. We are lower by about 1/10%. What really stood out to me is that you have heavyweight markets like China and Hong Kong, South Korea and Singapore that are off, so there is a real gap to work with here. US at 10 to 346.40. Growing concern that the bond market is riding down the inflation risks a little bit too much. The Bloomberg Dollar Index slipped by 0.1%, but it's still around a critical Fibonacci level. And then Brent crude just a little bit higher here in terms of the price on the week. But on the day, we are lower. I want to get to this chart, GTV Go, for our clients, to talk about the week that was for equities. We dropped 0.7%. That snapped a 2-week winning streak. Now here is the thing, the Ned Davis folks are saying that the S&P 500 has never bottomed before the start of a recession. They're forecasting a 75% chance that the U.S. will slump into an economic slowdown in the first half of 2023. Some indicators are saying that a soft landing isn't off the table. That's the caveat. And that means it's really difficult to position in U.S. stocks. I want to get to some news in the last hour around the Bank of Japan, which of course is moving to put a lid on yields for its government bonds. Intraday, we are at 129.62. The Bank of Japan offered 1 trillion yen for the 5-year loan operation. The interest rate is going to be determined by auction method, with the results expected at around 2 p.m. Tokyo time. With that in mind, I take you to the broader market action. Despite some of these markets being closed, you have markets like Japan, which are trading, so the stocks leading the charge here in excess of 1%, with Toyota contributing the most to the topic's gain, increasing just a little bit under 1%. I want to get to our top story. President Biden's lawyers are saying the Justice Department has found 6 items containing classified information during a search of the American leader's home in Delaware. I want to compare notes with Bloomberg's Dan Tenkate. So Dan, where does that leave us then? Because we keep getting more and more surprises on this front.
Yeah, in fact, this is the second discovery since Biden's lawyers said they had disclosed everything. So now you have even members of Biden's own party, the Democrat Party, expressing concern. Dick Durbin saying that Biden should be, quote, embarrassed by the situation. Democrats are very afraid that they're losing the moral high ground with former President Donald Trump, who's declared his intention to run in 2024 again. Who's also guilty of, not guilty, but has been accused of the same thing. So the Democrats have tried to say that the difference in the two cases is that Donald Trump is not cooperating with investigators while Biden is, but that argument is tougher to make among the American public and the electorate if they keep seeing this drip, drip, drip of news. So for Democrats, they're hoping that this goes away, but it's unclear if more documents will keep turning up and where the special counsel investigation will go from here.
Absolutely. That's the million-dollar question. Dan, thank you for that. That's Dan Tenkate with real-time analysis on the story out of the United States. I want to get to China now because the country says more than 12,500 people have died of COVID-related causes in the week leading up to Lunar New Year. Our Asia virus, our Emma O'Brien joins us again. So, Emma, what else can we get in terms of the potential fallout?
Yeah, I mean, it's really interesting that China is starting to report these COVID-related death numbers. This is the second week in a row that they have released these numbers. The week before, they said that basically the period from when they started easing COVID curbs until the start of January, there'd been 60,000 COVID-related deaths. Now, it needs to be noted that these are only deaths in hospitals, and they are likely to be very much undercounted, given the pretty haphazard way China seems to be approaching COVID data. They have come under a huge amount of pressure from the World Health Organization and from some countries to be much more transparent about the COVID situation on the ground, which is really difficult to get a handle on in a country of the scale of China, particularly when the government is being very selective when it comes to the data they want to release.
And then meanwhile, Emma reports that officials are looking to, quote, soon loosen travel requirements for mainland China. How could that take shape?
Yeah, I mean, the reports we're hearing are that they are going to ease some of the quotas around travel from mainland China into Hong Kong. There's also a PCR testing requirement still in place there. The fact they're not moving on this right now suggests some caution around the Lunar New Year holiday, which is often called the world's biggest temporary migration. It's a given that it's going to supercharge the outbreak that's already underway, no matter what Chinese officials are saying. So suggesting some caution there, but more broadly, it does reflect the fact that they are throwing themselves headlong into normalisation and into reopening so that they can get to a point where they can supercharge economic growth again. Let's see as that unfolds.
Yeah, it really is a process of discovery when it comes to the reopening of China, and we take it day by day. Thank you for providing us a bit of perspective. Emma O'Brien there, our Asia viruses are. I want to get you the first one headlines from around the world. Simone Foxman has those in Doha. Simone?
California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles has killed himself in a van as officers closed in. 10 other people were wounded in the attack in Monterey Park following a Lunar New Year celebration. Armed officers had surrounded a white van in Torrance, which is about 50 kilometers from the scene of the massacre, before the suspect shot himself inside the vehicle. The leaders of France and Germany are warning European businesses will need to unleash investments on a massive scale to keep up with the U.S. and Chinese firms. The Chancellor and President met in Paris to discuss how the EU should respond to President Biden's Inflation Reduction Act, which the bloc argues does not comply with international rules. EU leaders will meet next month to discuss options. Elon Musk is due back on the stand later in his securities fraud lawsuit. The Tesla CEO faced about 25 minutes of questioning on Friday over his 2018 tweets that funding was secured to take that company private before the San Francisco jury was sent home. He disputed that his tweets affect Tesla's share price and said they contain information the public should know. In Australia, economists are split on RBA Governor Philip Lowe's prospects for an extension of his role. 11 of 21 surveyed by Bloomberg say the governor deserves 3 more years at the helm. The rest argue that his policy and communication errors mean he should be replaced, preferably by someone from outside the central bank. Lowe's 7-year term expires in September. And South Africa may face at least 2 more years of persistent blackouts as the country overhauls its aging coal-fired plants. The state-owned power company Eskom says the outages are necessary to make space for maintenance. South Africa is suffering its worst ever power cuts, with Eskom implementing blackouts for more than 200 days last year and every day so far in 2023. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman. This is Bloomberg. Yusuf.
Thanks, Simone. Let's get you a bit of a preview of what else is still to come. An exclusive with the chairman and founder of one of the largest family-owned conglomerates in Dubai, that's Khalif Al-Habtoor. We'll get his outlook for the year ahead. But next, we'll talk market strategy with Emirates NBD, hear why they think markets may soon shift focus to earnings and to margins. This is Bloomberg.
This is the Lexus variety of electrification, inspired by, created for, and empowered by you.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
About a consulting project. In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Analysis you trust. Everything you need to get set for the start of U.S. trade. Watch Bloomberg The Open with Jonathan Turley. Weekdays on Bloomberg.
I expect that we will raise rates a few more times this year.
Monetary policy, there still is more work to do.
I currently favor a 25 basis point increase at the FOMC's next meeting.
Hikes of 25 basis points will be appropriate going forward.
I expect to continue tightening policy past this meeting.
The Fed is going to have to maintain rates at high enough levels.
Policy is going to need to remain sufficiently restrictive for some time.
Now, at some point this year, I expect that the policy rate will be restrictive enough that we will hold rates in place, just hold them in place to let monetary policy do its work.
We can, and if necessary, should adjust our overall policy strategy to keep financial conditions restrictive, even as the pace slows.
recent comments by Fed officials on the outlook for interest rates. While markets have grown increasingly confident that the slowdown in inflation will allow the central bank to soon end its cycle of aggressive hikes, fears remain that higher rates could drive the economy into recession. Since trading volumes this morning with many major centers in Asia closed for Lunar New Year celebrations, if you're celebrating, congratulations, we're called a 10th of 1% lower on the S&P 500 today. I want to bring in Anita Krishna Gupta, the head of equity strategy at Emirates NED. Anita, what do you make of all this Fed speak, and where does that leave your thinking about what's going to happen with rates this year?
Morning, Yusuf. I think we've had some very positive rhetoric from the Fed governors. And on Friday, the market changed course after Governor Waller spoke about, a slower, still accelerated Fed tightening. But the fact that we are seeing a 75, then a 50, then a 25 basis point hike is very indicative that, yes, the Fed could start to pause by mid-year. And that's what equity markets are looking forward to, is the certainty of where the Fed trajectory is going. Our own take is that the in-house view on Fed rates is that we would start to pause somewhere mid-year. And whether we see cuts in Q4 would, of course, depend on economic data and inflation numbers.
I was looking at one of the most read stories in the terminal, and it's about a JP Morgan model that looked at the probabilities of a downturn this year, but it also looked at asset prices and which ones reflect that best. And what they came to the conclusion of the 7 of 9 asset classes, from high-grade bonds, European stocks now show less than 50% chance of a recession, which is a big reversal from October when a contraction was effectively seen as a done deal across markets. So where do you see the most attractive pricing?
Well, financial conditions have improved. Now, that's both the positive and the negative for markets, because financial conditions improving too much is not what the Fed really wants in terms of controlling inflation. So where do we see the maximum, improvement coming? We think that the U.S. equities are priced appropriately right now. Close to a 4,000 level for the S&P 500 is actually a year-end target at 18.2 times price to earnings and flat earnings growth. Where are other risk assets priced? If you're looking at equities across Europe, across Asia, we see more growth coming out of Asia. So we see Asian markets, that is India, China, emerging markets on the whole, still have a lot of room to go up. So that's where we see the maximum upside at this point.
We had some more news from the Bank of Japan in the last couple of minutes. The 5-year loan program has drawn interest worth 3.1 trillion yen from commercial banks, and that is larger than the 1 trillion yen that was put on offer, with an average rate of 0.145% compared to 0.175% for the 5-year bond yield. Just run me through where you see potential risks around the Bank of Japan yield curve control unwinding over the next few weeks. Potential unwinding, let me put that clear.
Japan is again focused on growth, like a lot of other economies, including China. Japan has, of course, seen the impact of the COVID slowdown, the impact of lower exports during 2 years of COVID supply chain issues. I think the focus is going to remain on growth for Japan, and consumer demand picking up.
Okay, and where does that leave sort of your broader Asia call? Because I know you're overweight EM versus DM. That is a consensus trade, which also means that there's a higher risk of a reversion later on in the year. What could be the stumbling block to this EM euphoria that we see?
The biggest stumbling block to EM euphoria, of course, is the US dollar strengthening. We have seen the US dollar against a basket of currencies fall about 8% in the last few months. So the dollar weakening has been positive for emerging markets. The biggest catalyst, of course, has been the China reopening. Is that trade done? No, because actually we're going to see China demand start picking up by Q2. Markets are going to stay volatile, so I'm not going to say it's a straight path up for emerging market equities or for India or the UAE, where we have our strongest calls. We're going to continue to see volatility, and that's only going to change once liquidity conditions ease and once we see the central banks pivot.
You talk about cash in your research as well. Just trying to understand to what extent you've added to cash reserves for clients, or telling them to do so, and what the reasoning behind that is.
We're getting a very good yield on cash at this point from banks. So a little bit of cash in the portfolio, it's a small amount, it's about 5%, and that also gives you a bit of room to add once you see any kind of correction in the markets. So while we are not at this point advocating adding massively to equity markets, we are neutral, but we think that any pullback we see would be a great opportunity to add.
Anita, fantastic chat. Thank you for making the time. That's Anita Gupta, the head of equity strategy at Emirates NBT. You have much more.
This is the Lexus variety of electrification, inspired by, created for, and powered by you.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one, and through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
The UAE's foreign minister is hopeful there will not be a major global recession in 2023, and the Emirates will have a strong year. Thani bin Ahmed Zayudi spoke to my colleague Manis Franny at the World Economic Forum Davos.
I'm very optimistic. Looking at the numbers in the last quarter of 2022, the prediction was much worse than what we achieved globally. And the expectation for this year is very pessimistic, but from the discussion I'm very optimistic that we'll exceed all the numbers which has been predicted. And even when it comes to the recessions, I don't think there will be a major recession globally. It's going to be very mild or even much.
Do we escape in the Emirates? Do we escape in downdraft? Are we immune?
We're very immune. We did very excellent last year, and we're going to do an excellent performance this year as well.
Your job is to bring home the free trade agreements. That's what you hear talking about. I understand there's 3-4 more free trade agreements to come. Let's break some news. Will you tell me who will come near term this year?
We're going to conclude with Cambodia next month, and we're going to conclude with Georgia the month after. So first quarter we're going to have 2. We're almost done with Turkey. It's the last step usually takes a bit longer. And we're kicking off with Ukraine this month. Hopefully we're going to conclude before the mid of this year. And more to come.
What about the Philippines?
Philippines were in discussion. We initiated this discussion last year. The government election happened, slowed down, but reactivating the things down.
So this is the escalation of the policy you and I caught up with last year at the federal level when it was launched. That crutch of additional free trade agreements you just announced, how much more will that do for the economy?
This is going to boost at least 3.4 to 3.8% of our GDP by 2030. So this is another big boost to our GDP.
You've also you signed the FTA with India last year. There's a huge contingency here. Rupee dirham trade, I understand, is set to happen when, and
And what kind of commodities will you settle in rupee?
We're still in early stage discussion with India on this dirham rupee trade, and this is going to be focusing only on non-oil trade because of the other factors. It's at early stages. The minute that things are done between our central bank and the counterparts in India, things are going to move.
But is the infrastructure between the central banks there? Is it just a question of getting the last T's crossed and I's dotted? Is the infrastructure there?
Well, it's technically allocated to the financial people, but it's still at early stages.
I don't want to make the same mistake as made with the Saudis. Can we just square it away that you're not going to trade? Are you going to trade oil in rupee? Is that something the UAE would or would not consider?
No, it's not under consideration.
Okay, that's squared away. Obviously, there was a huge contingency in Saudi Arabia from China. The Emirates were there. All the GCC leaders were there. How close are you to a China FTA? Was there significant progress made in constructive discussions?
The discussion is happening. The negotiation is happening on the GCC front. We're part of the negotiation. Things are progressing. It's taking, as usual, longer than bilateral, which is the natural negotiation.
What do you want from China? What do you want the relationship to be?
China is our first trade partner, and for sure more is going to be good for consumers, for workers, for peoples, for businesses.
But do you want that to be tech? Do you want that to be manufacturing?
We wanted technology, we wanted industry, we wanted services, which we are very strong with, and we want it for our main industrial and export products.
The other dynamic that you and I touch on from time to time is tax. We have corporate tax going live in the UAE in the middle of the year. And the last time we chatted, you said, look, it's about a balance. I'm going to remove certain fees when I put this corporate tax in. We just had a massive alcohol tax reduced. What other business fees can you tell the audience today that you're really considering reducing?
There will be an overlap for some time between the normal fees and the corporate tax until we know the basis and the foundation, and then things will be left out. So it's going to be taking some time until things are going to be balanced. It's the first time we're applying it. It's going to take some time. The good thing about it that we're not going to apply the corporate tax on anything below $100,000, which just to make sure that SMEs are benefiting from the new ecosystem that we're encouraging and pushing for in the country.
Two things that the UAE are benefiting from. One are passports and that ability to get a passport while Europe closes those doors. How many passports did you issue to non-Emiratis last year? It's a big business.
Well, I don't have the number, Manos, on this, but we want people to feel home. So it's not only about passport. It's called the visa, which they feel that they're attached to the country and the whole ecosystem. There is no big differentiation between locals, residents, and the one who wants to live in the country. And that's why it's part of our welcoming signal to everyone. The UAE is the center to do your business and to grow from the UAE.
Let's just close off on the tax, because I come from Ireland, and they made hay with their corporate tax reduction. Taxes are rising in Europe and in the West. Here you are at 9% corporate tax. How important is it that is continuity, that's not going to ratchet continually upwards? Taxes rarely go down, Minister, as you know. What is the message on tax continuity? If I look at the EU, 22%, globally 23.5%, you're 9%. Message to the market on tax continuity.
We're always going to be an attractive hub and center destination to all businesses, as low as possible when it comes to tax.
I want to take you to equity markets in this part of the world, because on Sunday we key markets that we're trading, including Saudi Arabia, where we saw Saudi National Bank, Al Rajhi Bank, diversified financials broadly were up about 1.9%, Aramco with gains 0.8%. The weak link in the chain came through from utilities, but the gains also extended to the Egyptian Stock Exchange, up a third of 1%. But the big bounce relatively came from Doha with 0.9% of upside. I want to flip the board and get to your U.S. natural gas futures. They are the big movers in the commodities column, jumping after 5 weeks of losses as colder weather was forecast to sweep through western and central regions. And that, obviously, as would be expected, lifts demand for heating. We are up 9.1% intraday as we speak, just short of 350. I want to flip the board again and talk about copper. The upside continues on, look, persisting global supply risks, you've got optimism that China's reopening from COVID lockdowns is going to boost demand, and so we are at a 7-month high. And that is currently up 1.05%. From there, I flip the board again and take you to your equity view.
This is the Lexus variety of electrification, inspired by, created for, and powered by you.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg. I've been and seen it.
Lots of Bloombergs. Lots of Bloombergs. Lots of Bloombergs. Lots of Bloombergs.
I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Daybreak Middle East. Our top stories this morning. Thin trading volumes with much of Asia off for the Lunar New Year. But could fresh data due this week boost hopes the global economy can avoid a major slump? The leaders of France and Germany warn that European businesses will need to unleash investments on a massive scale to keep up with the US and Chinese firms. President Biden's lawyers say the Justice Department has found 6 items containing classified information during a search of the American leader's home in Delaware. And the UAE's foreign trade minister tells us he's hopeful of no major global recession in 2023, that the Emirates will have a strong year. I take you to the markets in Asia. We have quite a few of them offline, including the bigger ones like China, Hong Kong, Singapore, South Korea, Indonesia, Malaysia, Taiwan, and Vietnam. But we do have some trade that is up and running from heavyweight markets like Japan. So stocks seeing a little bit of upside here in excess of 1% on the top picks, driven by Toyota. A lot of the gains coming through from the automotive space. I want to get to the yen trade specifically around some of the actions by the Bank of Japan. Their bond programs are closely monitored, and so what the Bank of Japan has done is they have offered a trillion yen for the 5-year portion of the Japanese government bonds, rather. And what came through was 3.1 trillion yen worth of demand, so massively outshooting what is on the block. The average interest rate at 0.145% compared to 0.175% for the 5-year bond yield. Intraday, we are pretty much around the flat line, just short of 129.70. I also want to talk about an individual stock that is a standout. This one from India, Yes Bank, currently down about 8.6%. This is after we got an update. The central bank's order to write off riskier capital bonds issued by the lender, and that is part of the restructuring. And at one point, we were down about 12%, trading volume soaring, about 47% of the 3-month full-day average. We'll keep a close eye on that. Now let's get to the Al Habtoor Group, one of the largest family-owned conglomerates in Dubai with businesses in hospitality, automotive, and education, among others. Joining us now for an exclusive look on the year ahead is the chairman and founder, Khaled Al Habtoor. So Khaled, give us a bit of a sense of the kind of scale that your ambitions have for this year. How much capital are you looking to put to work?
Well, always they call Dubai and the jewel of the world, and we are here in the safest place for investment. Therefore, we are, the result of last year was positive, thanks God. Even during the pandemic, we learned a lot of crisis management, and we benefited better than 2019. Something really, as they say, God closed one door to open 20 doors. So, the result is good last year and the year before, and we are forecasting this year and the year after that also is positive, and it can, to improve tremendously in all areas.
Do you have a nominal dollar figure in terms of dollars? How many billions would the spend be this year in investments?
Well, there's a different type of investment in trading and investment in real estate. When we talk about real estate, we are investing around 2.8 to $3 billion this year in investment of real estate here and overseas. But when it comes to other business and trading, it is much better than that, much more, which we are forecasting, of importing car turnover, our car dealing, leasing, car dealing, and overseas. Really our investment will be huge this year, more than any year before.
Okay. Much of our coverage around the Dubai property market, which has been a global phenomenon, is about Russian capital underpinning quite a bit of the price moves. I'm wondering how sustainable you think the current property prices are, given that we're running into a period of higher interest rates and maybe the sugar rush from Russian inflows can fade.
Well, we have to remember something very important. Investment and money always go to the safe areas, and we are the safest among. And we won. If you assess us and the West, we are much better controlled, everything, under control, and definitely, and we manage things better than anybody else. This is why people have a lot of faith and trust in investing in my country.
So are you confident? Are you confident that property prices are going to be able to, get us much traction? Just give me a broad line on what you think is going to happen with property prices in 2023 in Dubai.
I think, not only you mentioned Russia. Russian is a small number because we have a lot of from different nationality, and even the local citizens of the country buying a lot of property here, whether it's land, apartment, or villas, or house, whatever. And a lot of from Asian, a lot of Asian are buying here, more than the European.
Khaled, you recently opened one of your properties in Beirut again after a prolonged period of renovation and restoration because of the blast that happened there. Just give us a bit of insight in terms of what's on your purchase list for this year outside of the UAE. What would you like to add to your assets?
Well, in Beirut, they opened the closed hotel, which is after the explosion of the seaport. Just to encourage or to give a little bit of indication and hope that Lebanon coming back, and Lebanon will flourish positively and will do great after soon. This is what I can feel, and there is several indication that shows that Lebanon soon will be back. with the Lebanon which we remember, Lebanon which we know, not Lebanon which is now.
Yeah. And how does that kind of set the scene for properties elsewhere? Are you buying in London? Are you buying in Budapest? What is on the shopping list?
Well, the shopping list, of course, London is a little bit difficult, but definitely Central Europe like Budapest and Slovakia and surrounding, and of course Austria. We are looking there, and we have a good strong base now in Central Europe.
Last time we caught up, just to kind of build into a broader point around the valuation of your business and how that could do in an IPO. You said that you had a plan and an intention to list on the Dubai exchange. When is that going to actually happen? Do you have a bit of a firmer date in mind that we can work with?
Not really. We will always make trial and error by doing it, but later I decided to postpone it at least for another few years, at least 3-4 years.
What is behind the postponement? So are we talking about 2024, 2025? Why did it get pushed back that far?
Maybe 25, 26, but because we want to show them our balance sheet is the strongest they ever seen in their life.
Okay, so it's on the back burner for now. Just some closing thoughts on the working week schedule and the weekends. You've tweeted quite a bit about that. Run me through what your thinking is and sort of how that maybe foreshadows what we can expect going forward.
I think there's a lot of people, everyone has an own idea. I don't believe personally, and my team as well, that we work from home or work through Zoom or work 3-4 days. Myself, if I don't work daily, then something wrong with me, And, this country has been built with the arm and the brain of the people. The leader, like Sheikh Zayed and Sheikh Rashid, they led this country with the people of this country to build it. They didn't build it by Zoom. They didn't build it by weekend 3 days. They were working 7 days a week, plus, they were from early morning, 5 o'clock in the morning, until maybe 10 o'clock in the evening. These people and the people of Dubai, people of UAE, were very hard to build UAE. You cannot work 3 days or 4 days and all on Zoom and this. You cannot build, we built this country, our leader and us, we built this country to success. We don't want anybody to demolish it.
Your skepticism of Zoom, we're having a Zoom call right now, so it's not always the case, but fantastic.
This is the Lexus variety of electrification, inspired by, created for, and powered by you.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Prime Minister Benjamin Netanyahu has fired a key ally from the cabinet in an early test to his coalition. And then on Saturday, more than 120,000 people took to the streets in Tel Aviv to protest his government's plans. Simone Foxman is watching the developments. So Simone, what's the state of play for his government?
Well, as we headed into the weekend, Yusuf, we were at a very tricky point for his brand new coalition because the Supreme Court of Israel had told a member, the second largest coalition group's leader, that he couldn't be in the Israeli cabinet because he was convicted of tax fraud last year and received a suspended sentence. So the question we were wondering is, will Netanyahu fire that minister, whose name is Aryeh Deri, or will he just ignore what the Supreme Court has said? So it looks like he's fired this minister. It doesn't appear that any other members of this party, which is called Shas, have yet resigned, keeping the coalition alive for now. But this is really just the beginning of the disputes we expect to see between Netanyahu's government and the judiciary system. And Netanyahu and his allies want to impose a lot of laws to reduce the independence of the judiciary. That's why we saw all those protesters turning out in Tel Aviv. There were also scattered demonstrations in cities across the country. The question is, do we see any market impact? Israeli politics is so tumultuous that often, we just don't see stocks, bonds, anything react. But there was a study that's just come out from a group of researchers, including a former Bank of Israel governor, warning that if you minimize the independence of the judiciary, you could see this show up in Israel's credit rating. They pointed to the experiences of Hungary, Poland, and Turkey, saying investors want to be confident in their contractual and property rights. So if you minimize the judiciary, maybe you cause investor concern.
And then in other controversies, the burning of a Quran in Sweden has set off outrage. What's the fallout?
Well, the initial fallout has been the cancellation of a planned visit by Sweden's defense minister to Turkey. There was also Turkey summoning the Swedish ambassador over this incident. And essentially what happened was a hard-right extremist person and some supporters the Quran outside the Turkish embassy in Sweden, and Swedish authorities let it happen, even though officials called this appalling. They said, we have these rights of free expression and this doesn't violate them. So this brought a lot of condemnation from across this region, actually, but particularly Turkey, outside, which the embassy was where this took place. And this really a further wedge in a delicate situation between Turkey and Sweden right now, because Sweden needs Turkey's approval in order to ascend to NATO, and Turkey's demanded a lot of things, many of which Sweden says it can no longer give. We are expected to see this issue, NATO ascension for Sweden as well as Finland, and Turkey's approval or lack thereof really ramp up over the next couple of months, especially as we draw closer to Turkey's presidential and parliamentary elections, those now officially confirmed for May 14th.
And then a mega deal that never happened. Saudi Arabia's sovereign wealth fund considered purchasing Formula One. Sources told Bloomberg the price tag in excess of $20 billion.
Yeah, a deal that never happened, and it didn't apparently get that far, falling apart in the early stages because Liberty Media Corp, the Formula One owner at the moment, didn't really want to sell this asset. The asset has done quite well since they purchased it back in 2017, and this $20 billion valuation would have been about 4 times the purchase price. But there is stock that trades that essentially tracks the value of this asset within Liberty Media. And that's where we get this kind of massive valuation, because before this story broke, it was about $15.2 billion. But this is perhaps not the end of us talking about Formula One. First off, we're going to see some events across the region for Formula One this year, including in Saudi Arabia next year. And sources telling us that PIF remains extremely interested in this asset. So if it did come up for sale, expect them to be a very strong bidder, Yusuf.
Yeah, and amazing onboard footage. I just can't get enough of cockpit cams, and you can tell what I do on the weekends. Simone, thanks for that. Simone Foxman, the Qatar Financial Center in Doha. Now let's get to the Middle East markets with our resident expert Farah al-Bahrawi. So Farah, away from Formula One to some of the ratings changes at Morgan Stanley for Saudi banks?
Yes, Yusuf. They initiated Arab National Bank at equal weight. They think that the bank is going to benefit from the growing corporate lending sector in Saudi Arabia. They think that the growth is going to be 10% in 2023, and it will show resilient numbers in the last quarter of this quarter, of the past year. So we had that for Arab National Bank as well as for Arashi Bank. They actually upgraded the stock to equal weight from underweight after it underperformed quite a bit in 2022 following a 100% rally in 2021. So they just think that there won't be a lot of downside to the stock price from here on, and they see some upside.
Meanwhile, what's the IPO pipeline looking at? Because we just heard from Al Habtoor, and that's now on the back burner. But what's on the front burner as well?
Well, on the front burner, according to Camco from Kuwait, they see 29 to 37 companies going public within this year. That's quite a deep pipeline for this region, or at least in line with what we saw last year. They think that the headwinds such as volatility in the secondary market as well as volatility in oil prices and geopolitical risks are still there, but they didn't stop companies from going public last year, so they won't stop companies from going public this year. They think that investors will continue looking for unique names that give new sectors to the region, as well as the dividend plays. You know that this is the biggest story here in the region, especially from the utilities sector, so that's the key one to watch out for.
You've been dissecting as well some of the news flow out of Oman on debuts. Run us through that.
Yes, it's not every day we get to talk about Oman, so it is exciting that we have OQ, the Oman energy firm, looking to list Abraj at what Bloomberg reported is considered to be a valuation of as much as $500 million. Smaller IPO than what we usually see from the other countries such as Saudi Arabia, but still a big name coming to the public markets in Oman. They have Ahli Bank of Oman as well as EFG Hermes and National Bank of Oman looking at the IPO, and it's looking for a listing in March, so that's one to watch out for.
Farah, excellent reporting. Thank you very much. That is Farah al-Bahrawi there. Still
This is the Lexus variety of electrification, inspired by, created for, and empowered by you. You trust everything you need to get set for the start of U.S. trading. Watch Bloomberg Be Open with Jonathan Turtle. Weekdays on Bloomberg.
Japan's inflation hits a 4-decade high. The CEO of the brewing and distilling giant Suntory says his company will raise wages. Speaking to us in Davos, Takeshi Ninami also said that the Bank of Japan and the government should not keep everyone guessing on what they're going to do next.
I think 6 is pretty much a good level. And how we can continue this trend to increase wages is a questionable, because how to increase productivity. So that is another issue we have to be worried about. But definitely, this is a great trend and a tipping point for the Japanese economy. People are, expecting to see the rate hikes, but except the small and medium-sized companies, and they are still struggling.
So is this because of wage increases? So small, medium-sized companies, I mean, this is what we've been waiting for, right? Higher inflation in Japan for a long, long time. How does it change the composition of the economy?
Well, first of all, there are two aspects as for inflation. Good side, it means a wage hike. The other side, the people are suffering. But I guess the total norm is, I think, even SMEs will increase eventually. But we big corporations have to give the fair amount of increase of price. So SMEs is still in question for the Japanese economy to be better. But I'm sure that will be happening among even the SMEs.
We talk about the Bank of Japan a lot. We've always talked about it a lot, but it's not really front page news, certainly in the last 5 to 6 weeks. Is it confusing what they're trying to do?
Yes, confusing. Because if we take a look at the market, it's really, confused. But I think down the road, we need to exit, and we need a roadmap to avoid the negative surprise to the people and corporates. But I think now is the right timing, because the entire landscape of our economy has changed. No peace dividends and inflation, so we got to change the entire policy taken by BOJ and the government. But we are not ready. But we need a roadmap proposed by BOJ and the government.
Do you think it will be under this governor, Governor Kuroda, or will it be up to the new governor appointed in April? The new governor. And you're confident that actually it will be a framework that markets will understand and that you think will make more sense for your country?
Yeah, well, because people got to know already down the road the interest rate will go up. For example, already mortgage rate is going up. So people, general public, feel something will happen, like increasing of interest rates.
Does the new policy help at Suntory?
I think so, because we are moving toward the further premiumization. And plus, definitely rate hike should follow.
What's your biggest challenge in the next 12 months? I know we talk about supply chain shocks, we talk about shipping, we talk about demand being quite volatile. What are you most worried about?
Gas price. And the energy crisis is still going on. And China is participating in buying commodities again. We don't know about that. And that might offset the Chinese economic growth. That is helpful to the world. So we don't know how they will take action to buy more commodities, buy more oil, buy more gas. That might increase gas prices.
So how can you protect yourself? Do you buy energy in advance or options in advance?
Well, we are moving toward the more premiumization to enjoy higher gross margins. So resilience for business is so important. So always innovation. So we are putting more money to R&D.
Fascinating conversation there with the Suntory CEO in Davos. Let's get to Dolly Yen on that note and some of the Japanese bond yields, because it is all about the Bank of Japan, who have made a 1 trillion yen offer in terms of the 5-year. They drew 3.1 trillion yen worth of demand, and this is all in a bid to limit the rise in bond yields. Japan's state pension fund said they don't need to change the portfolio allocation, even though the Bank of Japan's policy tweak last month had some impact on domestic bond investments. At the moment, the dollar yen up 0.5%. JGB futures are climbing 47 ticks. I want to flip the board, talk about equity futures on this Monday as we deal with quite a bit lighter flows, because we have holidays across Asia, including China, Hong Kong, Singapore, and South Korea. On the S&P 500 mini, there's a lack of direction. We are as unchanged could probably get 3 whiskers lower there. Euro stocks futures playing a bit catch up to the Friday close in the United States. Much more coverage ahead from London and the rest of the world. This is Bloomberg.
ship is much more than a flotilla of financials and numbers. Natalie Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, so sometimes we can come on board.
So functional.
Exactly, very functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space. And we created this bar, it went up and down.
Now, where does it take you?
The Instagram news, about that.
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. That's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it, then when you figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Danny Berger in London with the stories that set your agenda. Staking out positions, Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaus Knot sees at least 2 more 50 basis point increases for the ECB. Fading recession odds, JP Morgan modeling shows that odds of an economic downturn are falling across pricings in markets. The dollar drops, but stock futures mixed. Plus, closing ranks, Olaf Scholz and Emmanuel Macron warn European businesses that they will need to dramatically boost spending to keep pace with the U.S. and China. For these markets, we're coming off the back of quite a Friday. It was really marked by short covering. The U.S. benchmark, it rallied some 2%, but the most shorted equities rallied 4%. So what fueled that? Perhaps in no small part to Waller, who is very clear 25 basis points will be his next bet. It is the downshifting from the Fed. Now, I should say, though, for today's markets, it is very thin trading. It is the start, or at least yesterday was the start of the Lunar New Year for much of Asia. So Chinese markets closed, Hong Kong markets closed. Japan is open. The rally continues there. It is up 1 1/3%. The rally also continues in European futures, but it takes a breather in the U.S. Perhaps not surprising to see some consolidation after such a strong rally. Also, eyes turn to tech earnings next in the U.S. when Microsoft kicks things off on Tuesday. Looking across assets, the dollar is slipping against all of its G10 peers. The divergence is most notable, though, in the euro. The euro was gaining this morning when you have the hawks from the ECB dominating the conversation, while the Fed conversation is all about the downshift. Dr. Copper, that's trading at near a 7-month high, so some positivity there around the U.S. economy. And nat gas, that's the pricing in New York. It is cold. If you have been outside, you know this. Nat gas rebounding. It is up about 8%. Let's get some of our other top stories this morning and our reporters from around the world. Derek Walbank is going to join us with the latest on Joe Biden and Garfield Reynolds on the ECB and the Fed. Starting things there, the ECB hawks, they are out in full force. Governing member Klaus Knot called for a 50 basis point hike in both February and March, saying the time to slow tightening is, quote, still far away. So let's bring in Garfield for this. So Garfield, talk us through what we should be expecting from the ECB in the coming months, because we have heard some more of the hawks come into the force, but it's far from consensus, it would seem at this point.
Yeah, it's not consensus, Dan, but it is a very different situation to what we've got in the US and some of the other economies where the central banks are further along with what they're trying to do. Rates traders are expecting another 1.5 percentage points of hikes from the ECB. That's 3 50 basis point hikes or 6 25 basis point hikes. And they expect probably at least a couple of those to be 50 basis point hikes, which actually lines up reasonably well with some of the ECB members, such as Mr. Knott, who are seen as being hawkish, but the European Union is looking at an economy that is showing a fair bit of resilience. That's been a common theme around the globe. And resilient economies plus elevated inflation equals central bankers have the capacity and the incentive to raise interest rates until they see they're doing too much economic pain.
So, you talked about how this differs from what's happening in the U.S., where Christopher Waller was another one yet again to slow rate hikes. Just take a quick listen to what he said on Friday.
I currently favor a 25 basis point increase at the FOMC's next meeting at the end of this month. Beyond that, we still have a considerable way to go to our 2% goal, and I expect to continue tightening policy past this meeting.
Garfield, I am curious what you make of the narrative that, okay, it's time to downshift, let's see what the economic impact of our tightening has been, but at the same time, Waller and others saying we have more work to do, we need to keep rates restrictive.
Yeah, Danny, I think a lot of this has to do with the way that central bankers are trying to engineer the softest landing they can manage. And that means they want to tame inflation, done so, and they do want to try and do the least harm when they do that. But they understand that there is the chance of harm. They're willing to take that risk because the inflation problem has been so severe. We are coming down from a generational level of high inflation. And so central bankers have been very, very severe in their efforts to fight that. Now they're getting to a stage where, okay, we're in restrictive territory. That's important. Rates now are expected to slow the economy. The question is, are they going to slow it or are they going to bring it crashing to a screaming halt? They don't want to do the latter unless they have to. Hence, 25 basis points. Hence, also, we want to keep rates restrictive for some time. And that's a very difficult message to get through to markets who are like, okay, how much are you going to hike this time and how soon are you going to start bringing it back down?
Well, to that point, Garfield, you have a fantastic story out, which I highly recommend everyone read, about the split emerging in markets, emerging in CTFC positioning where you have hedge funds doing one thing and asset managers doing another thing. Garfield, what is that split and what does it tell us?
Okay, so we've got hedge funds, leveraged accounts. They've got the biggest shorts on US 10-year Treasury note futures since 2019. So they're expecting 10-year treasuries to fall, i.e. yields to rise from where they are. Remember, we've been in the middle of a very strong rally driving those yields down. Now, asset managers are taking the other side of the bet. They're long, the longest they have been since at least 2006. That's how far back the data goes. So we're looking at hedge funds who are saying, okay, when the central bank stops hiking rates, you get a steepening yield curve. That means you bet on long rates, long bonds underperforming short bonds. And they've started to shift away from the deep shorts that they had for 2 years. So that's the calculation hedge funds have got. Asset managers are looking at this rally and they're also looking at some of the highest yields we've had in more than a decade, and so say we're really willing to keep riding this train until we're coming off the rails. Last time we had the sort of split we've got now was late 2018. That was just before we got what the hedge funds are starting to expect, i.e. the top of the Fed cycle and the inverted yield curve moving back towards towards zero and then above.
Interesting stuff. We'll see if history repeats itself. Garfield, thank you very much. Bloomberg MLive's Garfield Reynolds. Now, let's talk about a different U.S. story, this one of the politics persuasion. President Biden's lawyers say the Justice Department has found 6 items containing classified information during a search of the American leader's home in Delaware. Let's get more with Bloomberg's Derek Walbank. Derek, just get us up to speed here. What do we know?
Well, yeah, this is another search that was done with Biden's approval, consent, help out, I guess you might say, to say, yes, you can go and search this residence that Justice Department goes searches. Turns up 6 documents, some had classification markings, some close in there. We're not really sure what those say at this point. But it's another... it's another thing that dropped in this now developing situation that the White House finds itself in with classified documents related to the president. Now, this White House would take great pains to say that this classified documents with this president and the classified documents with the last president, Donald Trump, are completely separate things, and there is some case to that. But this is exactly not the thing that this White House wants to be talking about right now, as the president is reportedly thinking about how he wants to announce a re-election bid. This is stepping all over that. Additionally, I think it's worth making the point that the White House was really gearing up for the idea that if Republicans took control of one or more houses of Congress, that they were going to launch a slew of investigations. They were really, really happy, actually, to see some of these committees of oversight get packed with people that they consider to be just complete bomb throwers. And they're just basically saying, okay, this is actually really good because no one's going to take this seriously. The problem that they've got right now, though, is that they've been handed a reasonably legitimate course of inquiry. Their documents that have classification markings on them being held in closets and garages and your personal home and things of that nature. And so whether or not you think that a committee is stacked with yahoos, it's pursuing what is generally seen as a reasonably sensible thing to be pursuing, which is that classified documents need to be kept in a certain way and not have been. I think the White House is very eager, and you can see this, though, with the cooperation, to take it on the chin for whatever this might be, and then get this behind them as rapidly as possible. And so that's what you're seeing. That's what you're seeing them do here.
Well, also in the background, or maybe not so much in the background, Biden is doing this aid reshuffle. Some people are staying in place, some people aren't. Amid that reshuffle, we're also expecting Biden to name Jeff Zients as Chief of Staff. Is there any significance to that appointment, Derek?
Well, it's one of the most powerful positions in Washington, the White House Chief of Staff. This is the top administrator, basically, in the federal government. And it's a really, really important position. I mean, you've got Jeff Zients, I think, is a name that pretty much everybody with a Bloomberg terminal knows pretty well. I mean, you're talking about somebody who's got extensive economic experience, extensive business experience, too, a person who was involved in running the U.S. COVID response, someone who's generally seen as a very, very good manager, but someone who is stylistically different than Ron Klain, his predecessor. I mean, for one, Ron Klain tweets all the time, retweets a ton of things, and Jeff Zients doesn't tweet at all. So, I mean, you're going to get a little bit of stylistic differentiation here, but when you're talking about the president shifting maybe from a policy-based first 2 years where both houses of Congress were under to a more antagonistic position and to more of a campaign-focused position, I think that this appointment is particularly significant. One other thing I would flag here is that Zients has a ton of economic experience, which is going to come in really, really handy considering what are the 2 big fights that we've talked about, you and I, on this program before, right? Debt limit, government funding. You're bringing in somebody who really, really market fluent with both of those issues, guiding that response. So I think that's another significant thing to be talking about here.
Yeah, I know Biden has spoken about his meeting with McCarthy and essentially saying no changes to the debt limit, what the Republicans want to push, it is off the table. Derek, thank you so much. Bloomberg's Derek Walbank getting us caught up on all things D.C. Now, closer to home in Europe, Germany and France are pushing for huge spending increases at European businesses so they can compete with their U.S. and Chinese competitors, of course, after that Inflation Reduction Act in the U.S., with those countries revamping their economies to make them more climate friendly. It also follows a summit between the French and German cabinets in Paris over the weekend.
Es ist notwendig, dass wir
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten, Aktivitäten in den USA bedeuten.
German Chancellor Olaf Scholz there talking about what the European response needs to be to the American Inflation Reduction Act. Now, what could that response do? What could its impact be on the economy? We're going to be covering that later with Deutsche Bank's chief German economist, Stefan Schneider, who was among the first to call that Germany will be able to avoid a recession this year. So why the change of disposition for the country? Stay with us for that interview that will happen in about 20 minutes' time. Let's first, though, take a look at some of the key things we're going to be watching out for today. We're going to have a whole lot of ECB speakers. That will start off with the central bank's most influential dove, Fabio Panetta. Then 3 p.m. UK time, we're going to get Eurozone consumer confidence data. Economists expect that will offer a glimmer of hope, which we all need at this moment. At the same time, we're going to take a look at the U.S. Conference Board leading index to get a forecast of future U.S. economic activity. Finally, today, we're going to be hearing from ECB President Christine Lagarde. Coming up, how likely are we to avoid a recession this year? A JP Morgan trading model shows that the chances are better than last year. We discuss that next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Money managers are pulling back on their recessionary bets through financial markets. Trading models from JP Morgan show that 7 out of 9 asset classes now show a less than 50% chance of a recession. So those pullbacks include the U.S. junk bond market. At one point, it was pricing in a 33% recessionary odd. Now it's around 18. Euro stocks that's at 26%. At one point, it was at 93. That is a really sharp pullback. And the S&P is still showing more than 50% chance of recession at 73, but at one point, it was basically shorty at 98%. So what does that all that mean? Do you want to follow that rally? Joining us now is Alan Higgins, CIO of Coots and Company. Alan, I actually want to start with something we were just talking about during the break, because JP Morgan here for their modeling is basing this off prior recessions? How close are we now to the pricing then? If we get a recession this time around, though, can you use the same playbook as other ones?
Morning, Danny. That is the key question because, well, I've seen a lot of recessions, but this is the most anticipated.
Yeah.
Whether you look at the number of economists predicting or Wall Street, so it's tough. But with pricing, with those kind of numbers, and especially how tight credit is, we want to lean against this market exuberance right now. And I guess one way I look at it is that there is a place to hide now. The short end of bond markets, US 4.25%, higher if you go for credit. So you are paid to be patient. And as we know, going back over the last 10 years or more since the financial crisis, it's been hard to find a return sitting there in near cash investments. So what makes me nervous, though, is exactly as you said, it's super anticipated this recession. But look, in my experience, every time I've betted against the yield curve, it hasn't worked that well. The inverted yield curve shows us pain to come, and earnings downgrades to come in particular. So, look, what does it mean? Probably buy dips rather than wait for a 20-30% correction. But we've had this kind of rally, the pessimism is priced out. Lean against it now.
It's interesting because when it comes to the yield curve, there's this one academic that I used to follow all the time in my quant days. He's kind of well-known quant, Campbell Harvey. I think he's now at the Duke Business School. And he had this research paper out that was essentially arguing what you're saying. Look, we have this really well-broadcast recession. The yield curve has been flashing all these red flags. But the yield curve is such a well-known recessionary indicator that it's different this time around because corporations maybe change their behavior. People change their behavior because we talk about recession so much. So I guess when you look at sort of the corporate side and you look at these companies, cutting back on costs, cutting back on expenses, letting people go, does the corporate world seem more prepared for a recession this time? And does that give you any confidence in terms of this equity market?
I think that's fair, and that means you kind of buy into corrections, and I get that. But, 2000 to 2003, we had a very, very mild recession, also an inverted curve. Barely an economic recession that you can see on the charts. Yet the equity market was devastated. Okay, it was expensive, ridiculously expensive.
Right.
But there was pain in earnings. That's the point. So the corporate sector taking some action means pain in earnings. Now, this is the issue. The US market is not a cheap market. At best, you could say maybe fair value.
Yeah.
Compared to bonds, maybe a bit on the expensive side. So I find it hard to go with the US market in particular, with it being so expensive.
I know you said you're waiting for a better entry point. What does that look like?
So it's a fair point. Because of everything we discussed, it's not a -20, -30 type event. It probably is a -10 to -15.
And this is the equity market.
They're talking about the equity market, and that will drag credit spreads wider too. I mean, everything you showed here from JP Morgan, if you bring up, for example, Bloomberg Financial Conditions, which takes into account credit spreads and equity market, you can see it's on the stimulative side now. The Fed won't like that. And so the Fed's gonna hold tough. Yeah, they're gonna slow down, but they're gonna hold in there. And there's so much easing priced in, so there's a lot of ground for disappointment. But yeah, it's quite nuanced because it is so predicted. So be patient, earn 4.25 in 2-year treasuries or thereabouts, and put some money to work on the corrections when it's going to be super pessimistic.
How hard is it to talk with clients? I mean, even peers really, Alan, and saying we need to be patient at this point. After a very long bull market where you didn't need to be patient, it was maybe too easy, you could buy anything, you could be rally. How much is investor psychology not geared towards the patient story anymore?
Yeah, it's fair. So look, we're a long-only investor principally. So look, we do own equities and bonds. It's just less than we would normally, you could say. So it's relatively straightforward on an advisory basis, and clients get that. On a discretionary basis, the message is, look, on this part of your portfolio, you're earning 4.25%. It's very different, Danny, from on this part of the portfolio. Sorry, you're earning 0. Like it as it has been. Yeah,
I can imagine that's not the easiest of conversations. So, another thing we've been talking a lot about today is this idea that perhaps the European outlook has gotten better, not just the global one, but Europe specifically. You said the US was very expensive, equities there. So is Europe at all more attractive to you?
So this is the big story, whether it be last year or continuing. Last year, I think value outperformed growth in the US by circa 25%. Really, really quite amazing. And of course, we saw better performance from value markets like the UK. So you're right, the energy issue obviously looks a lot better. And yes, so earnings are going to be troubled in Europe, but at 10 to 12 times earnings, 10 times in the UK, 12 times in Europe. So that's very different at 17, 18 times earnings. So yes, we stick with value. We of course we have some exposure to tech, but relative to the investment management industry, we have a fair bit of value in the portfolios, and we stick with that. It's the right trade.
Okay, Alan, thank you so much for joining us, for coming in the studio, telling us the right trades. Alan Higgins there, CIO of Coutts & Company. Now, coming up, U.S. Treasury Secretary Janet Yellen tours several African nations as Chinese influence in the region continues to grow. We'll bring you more on that next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you.
If
you
I
have
could
no
have
legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
U.S. Treasury Secretary Janet Yellen is on a 10-day Africa tour this week, meeting business leaders and officials. Joining us now to discuss is Bloomberg's Africa correspondent, Jennifer Zabazaja. Jen, great to have you doing your visit to London this month. So why is Yellen in Africa? Why this trip now?
Yeah, I mean, Danny, what we really saw from the administration at the end of 2022 is a re-engagement with this continent after years of the U.S. really sort of taking a step back. And so what we're seeing from the Biden administration is wanting to show that their commitment is there. So Secretary Yellen is there now on a 10-day trip. She's going to 3 countries. She was in Senegal, which they've campaigned to be a part of the G20. She's also going to be in Zambia, which has a number of default, in particular, debt to China, and then she'll go to South Africa. And so she is really sort of the start of the administration's introduction, or I'll say reintroduction back into the continent. We'll see President Biden going there as well. And so we're really just, I think, really seeing them making that commitment known and taking their words into action at this point in time.
Yeah, and less than a minute here, Jen, so just quickly, what could the U.S. do to sort of counter that Chinese influence?
Yeah, I mean, when you talk to U.S. officials, they say it's not about China, but what they are doing, what we've seen them doing, is making even more investment. So at the end of last year, we saw $55 billion be committed onto the continent. We've seen Secretary Yellen talking about a number of projects and initiatives that are meant to help spur growth and investment. And so this is what they're trying to do, but we still have obviously a number of Chinese and Russian officials in the area.
All right, Jen, thank you so much. Really great to have you with us this morning. That's Jennifer Sabzaja, our Africa correspondent. Coming up, the UK turns back to coal. It's cold outside. We're going to discuss that next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about mitigation.
Yeah,
or are you also talking about agriculture as mitigation?
Yeah, so every year emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Good morning, this is Bloomberg Daybreak Europe. I'm Danny Berger in London, and these are the stories that set your agenda. Staking out positions, Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaus Knot sees at least 2 more 50 basis point increases for the ECB. Closing ranks, Olaf Scholz and Emmanuel Macron warned European businesses that they'll need to dramatically boost spending to keep pace with the US and China. Plus, fading recession odds. JP Morgan modeling shows that odds of an economic downturn are falling across markets. The dollar drops with stock futures mixed. Well, look for a better entry point. That's what we just were discussing with Alan Higgins of Coutts & Co. earlier in the hour. And so far, it is a rally that started on Friday in the U.S. It is continuing, but just a caveat to put on all of this. It is the Lunar New Year in China for much of Asia, so trading volume is really, really thin. Even so, we are looking at a Japanese market that is up 1 1/3% and a European Stocks 50 futures index that is continuing the rally from Friday. S&P a little bit softer, but again, given the massive rally where the most shorted equities gained 4%, not surprising to see some consolidation. Cross asset, it is about that divide between Europe and the U.S. when it comes to central banks. They're not calling for 2 consecutive 50 basis point hikes. Waller says they're going to downshift to 25. Dr. Copper, that continues to trade at a 9-month high. Natural gas, that is pushing higher. It has fallen really significantly throughout the entirety of this year so far and the last few months of 2022, but it is cold and demand is moving higher. Speaking of which, that's a really prominent story in the UK, and the UK's grid operator has asked 3 coal-fired power units to be ready to generate electricity from as early as today as it boosts power supplies during a cold snap. For more, we're joined by Bloomberg's Lizzie Burden. Lizzie, anyone who's been outside knows how cold it's gone. I don't know about you, I've switched back to my giant parka for this weather. So how bad has the situation really gotten?
Yeah, I must confess I haven't cycled in as I usually do this morning. It is that cold. But it's freezing and there's not a lot of wind, so it means there's more demand and there's less supply of energy. So this is why you've got these 3 coal-powered units being fired up just in case of being needed, as well, given Russia has cut its gas supplies, and it's the first time this winter that they have been put on standby. But I should say, National Grid has tweeted that it doesn't mean electricity supplies are at risk or that people should worry. It's just a backup measure. It just sounds extreme, because the government, of course, has said that it'll stop using coal power by next year.
And to that point, how extreme is that? How bad does it need to get, or is it even close to the level where they start telling people you need to cut back on demand?
Well, there is such a thing as the Demand Flexibility Service, and that's also going to be on standby today. People are going to be paid to reduce their consumption between 5 and 6 p.m. That's peak time, and it's expected that £1 million will be paid out to hundreds of thousands of households, so about a couple of pounds per household. It's for people with smart meters. The more you reduce your consumption by, the more you get. And it's not that they want people to sit in the dark, Danny, but it's that they want people to spread out consumption throughout the day, boil your kettle, load your dishwasher just outside that peak hour. But as you suggest, it's significant because on one hand you've got this supply measure with the coal-powered units, on the other hand the demand measure as well, which people have been calling for a long time.
And what we're talking about energy, the story in Europe is really focused on the response to the American Inflation Reduction Act. There, of course, has been reaction in the UK as well. We've had CBI chief Tony Danger. He's expected later to call on the government for its own response. What are we expecting?
Yeah, the US has the Inflation Reduction Act. Europe, Brussels, has also said that it's going to support unprecedented levels of investment into clean tech. So this is the CBI saying to Britain, pull your socks up, we need a green strategy as well. Remember, Shadow Chancellor Labour's Rachel Reeves at Davos last week said that Britain cannot afford to just sit on the sidelines and carp on about what others are doing. So this is Tony Danker of the CBI, Britain's biggest lobby group, saying we need deregulation and we need state funding. And it isn't just the CBI that's saying this. You had the former Conservative Energy Minister Chris Skidmore in a report earlier this month saying, quote, that net zero is the growth opportunity of the 21st century, but the current inertia means that Britain risks losing jobs to elsewhere and investments, of course, if it doesn't step up. You also got CBI research out today showing that in the past 2 years, Britain's already lost market share in battery production and in hydrogen. That's going to be the equivalent of £4.3 billion by 2030. So this is really an arms race for green tech.
Okay. Lizzie, thank you very much. That's Bloomberg's Lizzie Burden staying warm. That's a good economic indicator. Does Lizzie cycle into the office, or is it too cold? Lizzie Burden there. Now, just to recap what's happening in Germany and France, as I was just talking about with Lizzie, they're pushing for huge spending increases at European businesses so they can compete with their U.S. and Chinese competitors. Those countries are trying to revamp their economies, make them more climate friendly. Of course, there's the Inflation Reduction Act in the U.S. It all follows a summit between the French and German cabinets in Paris over the weekend.
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten und Aktivitäten in den USA bedeuten.
Now, the hopes of a mild winter, or at least what we've had so far, means that economists are increasingly calling for the euro area to avoid a recession. Now, one of the first out the gate to make this call was Deutsche Bank. They saw a brightening outlook for the economy, specifically Germany, with output there proving surprisingly resilient at the end of last year. Joining us now is that economist who made the call of no recession in Germany. It's Stefan Schneider, Chief German Economist at Deutsche Bank. Stefan, thanks so much for joining us this morning. I probably just want to start there. So on the 13th of this month, you said Germany no longer going to have a recession. Before we go down the path of talking about the bright, sunny outlook, just want to make sure, has that view changed at all? Are you still calling for no recession in Germany?
I think we can safely call for no recession, although, I mean, on the 13th, basically the trigger was the release of the preliminary numbers for 2022 gross GDP, which was 1.9%, and the statistical office said that they expected that the fourth quarter GDP was flat. So, contrary to market expectations, that there was going to be a modest decline. Now, between zero growth and minus 0.1, I mean, that's a very fine line. So it could well be that when we get at the end of the month, the final Q4 numbers, there might be a modest decline. And then we could also see a modest decline in the first quarter. But overall, I mean, that's what economists call a technical recession. But compared to the expectations we had that there would be a severe winter dent to growth, I mean, we are avoiding the recession.
Well, what is the biggest risk to that, to actually going into a recession? What could tip the scales towards the negative?
I mean, basically, we are discussing margin of errors. I mean, the risk, actually, the two major risks we saw making the initial call that Germany would go into a recession was weakness in China's growth coming out of COVID. And it was obviously concerns about the energy supply, the gas supply in Germany. And both have eased considerably. So in this respect, I think the short-term risk, unless there is a major setback in terms of energy supply, which I currently can't see, or we get, I mean, even if we got now a cold spell for several weeks, I mean, the levels in the gas reservoirs should be sufficient enough. So the short-term risks are really diminished, and there is no single risk which is standing out.
Yeah, Stefan, how bad does the weather need to be that we actually worry about it? Because we could say, okay, it gets to freezing temperatures in Frankfurt right now. When does the switch happen that we say, okay, this actually is an issue? It's been cold enough, long enough that we should start to worry.
I mean, it should be something, which goes, let's say, through the whole month of February and into early March. But obviously, that's something by March, usually for seasonal reasons, the temperatures are picking up. So it's pretty unlikely.
Okay, fair enough. So it needs to be much worse than it currently is. So you mentioned how the brightening Chinese outlook is benefiting Germany right now. How do you weigh that up between a potential recession in the U.S., a potential recession elsewhere in Europe? How do you look at these two different factors weighing on each other in terms of German output?
Yeah, I mean, you have to see the timing perspective. I mean, the first thing is that we predict a recession in the U.S., but that's in the second half of this year. So far, it shouldn't have a strong impact on German GDP growth. And then, we discussed an improved outlook for the German economy, and obviously that's mirrored in, our European neighbors. So I guess with the decreasing likelihood of a recession in Germany, that also holds true for the rest of Europe. So in this respect, it's not basically direct, it's another positive that some key markets are looking somewhat better. And if you look at multipliers, obviously what's happening in the rest of Europe, given Germany's export exposure, is extremely important. Maybe China might not be as important as it traditionally is because the rebound is mainly private consumption and services, so there's less import content, but it's the sentiment which, is important. And if you look at the indicators, it was really the business sentiment which tanked in the second half of last year, and it's now picking up, and we think, looking at equity markets, for example, that's going to continue, and that's really very important at that stage.
Stefan, Schultz and Macron have just met. A large part of their discussion was a response to the American Inflation Reduction Act, the concern being that it is favoring and prioritizes American green companies at the expense of European ones. What's at stake if Germany and the rest of Europe doesn't respond and enact its own legislation to support green technology in the region?
It's a little bit between a rock and a hard place. I mean, first of all, we have already a competitive shock. Despite the decline in energy prices and gas prices we have seen over the last few weeks, I mean, they're still substantially higher than, let's say, 2019. So in this respect, especially the energy-intensive sectors in the European economy are facing a competitive shock. And if this shock was basically exacerbated by the legislation in the US, obviously that would make things more difficult. Now, on the other hand, I mean, as economists, we know that basically subsidies are an efficient way of using economic resources. So the last thing we really need would be a subsidy raise among major regions in the world.
Okay, so what does that solution look like? I know I'm asking a hard question of you, but is there something that's able to toe that line?
The solution would obviously be that we get some concessions from the US, like some of the neighboring countries. And so it would be much better, if the competitive disadvantage could be avoided in the first place, rather than basically enact more legislation and funding on the European side to counteract it.
Okay. Stefan, really great to have you on the program this morning. Stefan Schneider, Chief German Economist at Deutsche Bank. Coming up, Europe's earnings season kicks off. The consumer sector is particularly in focus for inflation and recession indications. Will we avoid a recession, as Stefan Schneider says? Well, more on that story next. This is Bloomberg.
More activity in the fusion world than ever, not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity can work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
What's going to keep reading World Cup? This is a story as the economic picture does.
One of the biggest names in business choose Bloomberg.
Great question.
It's a great question.
Great question. Great question.
Best question I get all night. Bloomberg, top experts, great questions.
Earnings season in Europe kicks off this week with the food and retail sectors particularly closely watched for inflation and recession indications. Primark owner AB Foods is due to report tomorrow, with H&M coming in on Friday. For more, we're joined by Bloomberg's deputy team leader for breaking news, Charles Capel. Okay, so Primark, H&M, those sort of low-end consumer companies, what are we expecting from them?
Yeah, well, one of the things we're looking out for is whether consumers are trading down a little bit. So instead of going for those more mid-range brands when it comes to buying their apparel,
We're going to be seeing whether they're going to be going for the cheaper brands, the likes of Primark, the likes of H&M, and then also interestingly how they fared over the holiday season. You know, we've heard from a lot of retailers that perhaps it wasn't as bad as expected, but that will be something we'll be crucially looking out for. And then on their outlook as well, we'll be seeing whether those price increases have managed to offset the increases in their costs, and whether that's going to have any impact on their margin. But it's really going to be the state of the European consumer. How are they holding up?
Well, speaking of the consumer, airlines are also in focus this week. I know in the U.S., for example, United, their shares fell even though they had a pretty strong outlook. How are we thinking about European reports for airlines?
So the two airlines we'll be looking at this week will be EasyJet and Wizz Air. Now, there's one thing that both of those have in common, is that they're relatively cheap.
I was going to say cheap seats.
Exactly. And the thing I'm interested in is, are people trading down like they are perhaps in their clothing and apparel, or are they just cutting out their international holidays? And if they're cutting out, then that could potentially affect those airlines. But those airlines both could do really well from people trading down from the more premium carriers, maybe trying to spend less on their travel, enjoying a holiday a little bit more. Now with Wizz Air, one of the things to keep an eye out for is the Middle East expansion, which is really strategically important. And then with EasyJet, it's how they fared over winter as well, and whether that poor snow in the Alps kept people away from booking holidays.
While we have you, Charles, I did want to ask about the U.S. tech story, because they've got some earnings coming this week. We learned on Friday that Alphabet, Google's parent company, they're slashing jobs. Has the outlook changed for American tech for this week, for their earnings?
So for American tech, it's going to be a little bit more tricky, right? So Microsoft has also said that they are looking at cutting some jobs, I think about 10,000 jobs. Now that's going to give them an impairment charge of about $1.2 billion, and it's also going to impact their adjusted EPS. The other companies to keep an eye out for is Intel, and whether the slowdown in consumer demand, perhaps people are buying fewer mobile phones, they're buying fewer computers, they're spending less on those big tech purchases. Is that going to start to affect their top line? Is that going to start to affect their volume impact as well? So it's really something we're looking out for.
Okay, Charles, thank you very much. Getting us set up for this week in earnings, as Charles Pell of our Breaking News team. Now let's get to some of our other top stories with the First Word News. And activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands Elliott's stake is worth a multi-billion dollar sum. The investor is known for seeking more representation and pushing for strategic changes. Ken Griffin's Citadel made a record $16 billion in profit for clients last year, the largest ever return for a hedge fund. According to estimates by LCH Investments, the top 20 hedge fund firms generated $22.4 billion in profit after fees. Citadel's gains surpassed that made by John Paulson on his bet against subprime mortgages back in 2007. Germany and France are warning European businesses that they'll need to unleash investments on a massive scale to keep up with the U.S. and China. Leaders of the two countries met in Paris to discuss how the EU should respond to President Biden's Inflation Reduction Act. The bloc argues Washington's plan unfairly subsidizes U.S. companies. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as officers closed in. 10 other people were wounded in the shooting in Monterey Park following a Lunar New Year celebration. Armed officials surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. And that's your First Word News update. Coming up on the program, Morgan Stanley cut CEO James Gorman's pay for 2022. We're going to have more on that shortly. This is Bloomberg.
For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Let's take a look at some of the events that we're going to be following throughout the week. Today, the ECB's Christine Lagarde is due to speak at an event following Klaus Schwab's call for 50 basis point hikes. Tomorrow, we're going to have PMI data for the US, UK, and Euro area, as well as earnings from Microsoft. Then on Wednesday, it's Canada's rate decision, followed by ASML and Tesla earnings. Then on Thursday, there is a whole lot of data coming out of the U.S. That will include fourth quarter GDP, initial jobless claims, durable goods, and wholesale inventories. On Friday, it's U.S. PCE deflator and Chevron results. Well, we've already gotten all the results from the big American banks, and as a result, Morgan Stanley has cut CEO James Borman's compensation by 10%. It'll now be $31.5 million for 2022. The bank said it had been a challenging economic and market environment. Joining us to discuss is Bloomberg's investing editor in Asia, Russell Ward. Russell, it's interesting because JP Morgan left Diamond's pay untouched. Morgan Stanley, by all accounts, had a better earnings season than some of their other peers like Goldman. So what do we make of the pay cut?
Hi, Danny. Yes, it's quite a contrast in approaches from JP Morgan and Morgan Stanley. So, in Morgan Stanley's case, the board has decided that he will have a 10% pay cut reflecting the bank's performance, even though it performed quite well in a challenging environment. Nevertheless, its profit fell 25%, or more than a quarter from the previous year. Shares were down 13%, and so the board has decided that James Gorman should be paid a little bit less than the previous year. In contrast to that, of course, we had a day earlier JP Morgan's board saying that Jamie Dimon should keep his pay unchanged at $34.5 million, and that reflected his ability to keep clients served in this challenging environment. And so quite contrasting approaches, remembering that a couple of years ago, James Gorman actually overtook Diamond to become the highest paid CEO on Wall Street. And so it's a bit of a change in fortunes for the two, reflecting last year's performance.
Yeah, I was going to say, he still was one of the most highly paid, and you mentioned that it was a small pay cut. He's still getting paid $31.5 million for 2022. How does this compare to the overall banking story when it comes to remuneration and staff hirings? Because it does feel, Russell, there's been increasing announcements of pulling back on pay for a variety of different bankers and hiring in general.
Yes, I think in Morgan Stanley's case, they're really sending a signal that they're bracing themselves for the economic downturn coming up. Inflation is sticking around, rates are still going up, and we know that Morgan Stanley is cutting 1,600 positions going forward in this year, and also trying to keep a lid on costs. So really, this is sending a signal that these sorts of belt tightening efforts are going right up the top.
Okay. Russell, thank you very much. As Bloomberg's Russell Ward, thanks for joining us. And as you can see on that board that was just up next to him, it has been a very tough year for the banking sector, though the likes of Citi, for example, raising junior banker pay. So it is not a clear story across the board. There you go. There is the 1 year for banks. Citi down some 19.25%. Well, that's it for Bloomberg Daybreak this Monday morning. Up next is Bloomberg's Market Europe. Again, a very quiet morning, given that most traders in Asia are off for the Lunar New Year holiday. But can the rally continue? This is Bloomberg.
You're one of the most fascinating entrepreneurs. You all started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. Which is a bit sad.
From age, what, 5?
I'm not sure. I come from a family of entrepreneurs, so even I probably can spell the word and still can't get it. It's sort of in my blood. But it's really fun starting businesses and fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very definitely from about 15. But I'm sure it's, you feel surrounded by it, it's very natural. So yes, it's fun.
And you started by making, you went to Florence. It was in Italy and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16 when I bought handbags. And I remember how it made me feel. And I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important. And that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating. Actually, I watched the offshoring and I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
During Friday's session, let's talk about a different dimension to that transatlantic relationship. France and Germany are pushing for huge spending increases so European businesses can compete with the US, but also Chinese rivals. It follows the summit between the French and German cabinets in Paris over the weekend, where they discussed their shared concerns about President Biden's enormous plans for green spending.
It is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten und Aktivitäten in den USA bedeuten.
For more on this, we're joined now by Bloomberg Senior Editor Benedict Camel. Benny, very nice to have you with us. Tell us a bit more about what was discussed then at this summit in Paris, because it seems that Europe is all in favour of anything that looks like a global sort of wave of green investment, but wants to push back against any protectionist elements to that.
Yes, you're absolutely right. So that is really a conundrum. On the one hand, Europe wants to
front of green technology, of sort of future energies. On the other hand, they don't want this to be an uneven playing field. We heard just now from German Chancellor Olaf Scholz in Paris saying we don't want to be treated any worse than the direct neighbours of
We are having problems. Just check. Ben, can you still hear me?
I can hear you. Yeah, I'll keep
okay,
going.
Excellent. Apologies. Yes, well, that's really interesting. Let's move on to what this means then in terms of European leaders and their willingness to be involved in European companies or to direct European companies in some way. What did we learn on that front?
So there was an effort, or there was a pledge out of this Paris meeting to really increase spending in that field of future energy, hydrogen, batteries, wind, solar, and so on, and really unleash that kind of investment in Europe. And that's one of the options that they have available. The other, obviously, is the other end, which is a trade war with the US. And Macron and Scholz have made very clear that's not really what they want. We had an exclusive interview with Scholz in Berlin last week, where he said that we don't want a trade war with the US, but if we can't reach some kind of an agreement, be it via the WTO, be it through other channels, that might be the way they have to go. For the time being, they're saying we want to counterweight in Europe, which means unleashing spending over here to have something of a response to what the US is doing with the IRA.
Okay, thanks very much. Thanks to Benny Benedict Cowell joining us there with the latest on the Franco-German relationship, I suppose, and indeed the European pushback against US support in some senses. Now, coming up on the programme, we'll talk about the UK. The UK is putting coal-fired power units on standby as the cold snap sweeps across the country. We've had guidance from the National Grid not to worry about this, if you like, saying that this is just a precaution. It doesn't mean that electricity supplies are at risk, but we will get the latest, clearly from an environmental perspective. This is not what anybody had planned. We will talk about this shortly. This is Blinkback.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly.
And then the fund just typically lasts maybe 10 years or so.
15, but these days longer, so often 15, often the tail extends out 20 years. These companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
Top-end venture is sort of 3x net of fees. You ideally hoping for more than that. You're hoping for 5x or more. You're liquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
maybe to 20 to 40% if things go well. Is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? Is it high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former ship salesman. You've got people with very different. Nugent Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and that there seems to be a taste component to it that's really hard to measure and really hard to predict.
bigger challenges next.
Was going to keep Green World Cup. This is a story
as the economic picture does.
Is the occasion ready today?
This is Bloomberg Daybreak with Lee.
Welcome to Daybreak Australia. This is Hannah the Close. Welcome to Bloomberg Crypto.
Welcome back to Bloomberg Markets Europe at 7:30 here in London. Half an hour until the start of cash equities trading. Let's get to the top stories. Staking out positions, Fed hawk Christopher Waller says he favours a quarter-point hike at the next meeting, while Klaas Knot sees at least 2 more 50 basis point increases for the ECB. Fading recession odds. JP Morgan modelling shows chances of an economic downturn falling across markets. The dollar drops with European futures up. Plus, closing ranks, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the US and China. Welcome back to the programme, everybody. Let's have a look at the futures picture then for European equity markets. And the futures in London look fairly flat, but elsewhere perhaps a little bit of upside over on the German market. A lot of this may be coming through from the US. S&P up by 1.9% on Friday, Nasdaq up by more than 2.5%. It's a mixed bag of news flow, some supportive dynamics around the earnings story for the S&P. On the Nasdaq front, maybe job losses in the tech sector, Netflix subscriptions going higher, so that's a tech focus, of course, along with options expiry during Friday's session. So there was a lot going on, and we need to factor some of that into the European trading day. Also keeping an eye on what's going on with the euro. We've been above 109 on euro dollar this morning. Broadly, we are seeing some weakness in the dollar this morning, and the euro strength is one big factor of that. We've been above 109, now back down to 108.95 or so. This is the 4th day of strength coming through for the euro after we saw quite a bit of hawkish pushback to some dovish ideas around the ECB last week, and those hawkish voices of the ECB keep coming out, and certainly they were out in force over the weekend. It's the first time since April that we've seen the euro go up 109, so interesting to keep an eye on what's happening there in FX markets. Now, away from the macro, we're also keeping an eye on some of the tech names. We've got our eyes on these tech giants and chip makers. Plenty of them will be reporting this week. For more, let's bring in our Bloomberg Markets reporter, Valerie Teitel, who's been focused on this sector. Valerie, good morning. So there's been a lot said about job losses, and we were just talking about Alphabet, the Google parent, on Friday. So a lot to be said on that front. What do the numbers look like?
Yeah, I had a look at the Bloomberg intelligence data of what we're expecting from this earnings season, and they see that the tech sector, especially within the S&P, the information technology sector, to be the biggest drag on profits. They're forecasting over 9% drop from third quarter last year, this is the largest fall in this tech sector since 2016. And it's notable, Anna, 2016 was when the Fed was guiding their last hiking cycle. Very much the same narrative was going around the tech sector back then about easy money being pulled away. But funny enough, if you look ahead to what Bloomberg Intelligence sees, the second half, they see this returning to profit. So a lot of this narrative about, like, are we being too optimistic when it comes to equity earnings? It's especially evident in the tech sector, especially as even our own intelligence sees that they might return to profit in 2 quarters' time.
Okay, so that's some of the dynamics that are being watched by some analysts, Valerie. What about the broader investor community? How does that chime with what they're thinking at the moment?
Yeah, I think a lot of investors are kind of echoing the same narrative that earning estimates are still too high. A lot of the strategists see some further decline on this growth outlook. But look, it's 2023. We're still very uncertain what the outlook for the U.S. economy is. And perhaps the equity market is taking a page from the fixed income market. As we know, we have quite a sizable easing cycle now priced in for the Fed in the next 18 months. We're really pricing in this soft landing and the Fed cutting to neutral, and I think that is probably what the tea leaves that the equity market is reading at this time.
Yeah, it'll be really interesting to see the extent to which earnings reports are in the driving seat for big tech versus the Fed story, which of course was so dominant last year. Thanks very much to Bloomberg's Valerie Teitel for a chart update. GTV Go is the function to use if you want to see Valerie's charts, and indeed all of the charts that we use here on Bloomberg TV. Let's get a Bloomberg Business Flash, some of the other top corporate stories we're covering this morning. Here's Alice.
Hi Anna. Activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands Elliott's stake is worth a multi-billion-dollar sum. The investor is known for seeking broad representation and pushing for strategic changes. Ken Griffin's Citadel made a record $16 billion in profit for clients last year, the largest ever return for a hedge fund. According to estimates by LTH Investments, the top 20 hedge fund firms generated $22.4 billion in profit after fees. Citadel's gains surpassed that made by John Paulson on his bet against subprime mortgage back in 2007. Morgan Stanley has cut CEO James Gorman's compensation by 10% for 2022, a year which saw profits tumble and shares sank. The package includes $1.5 million in salary and a $7.5 million cash bonus, with the vast majority of the total coming in the form of shares. The cut leaves Gorman's total compensation at $31.5 million. That's your Bloomberg Business Flash. Anna?
Alice, thank you very much. Alice Atkins here in London. Now, let's turn to the UK. The UK's grid operator has asked 3 coal-fired power units to be ready to generate electricity from as early as today, as it boosts power supplies during a cold snap. It certainly is cold. Let us get to Bloomberg's Lizzie Burton, who can take us through some of the details here. Good morning, Lizzie. So, how bad is this situation that the National Grid is having to call on these resources?
Well, just waking up this morning, Anna, it's freezing, it's foggy, there's not a lot of wind, so it means there's more demand for power and less of it. It does sound extreme because the government has said that it wanted to end coal power by next year, but National Grid is turning to these 3 coal-fired units just in case, because of course Russia has cut its gas supplies, and so perhaps this may be needed on standby. National Grid has specifically tweeted that it doesn't mean electricity supplies are at risk or that people should worry. It's simply a backup measure.
So we shouldn't worry, but should we dial back usage? I mean, anecdotally, we talk to plenty of people who've been dialing back their usage, but under a previous administration, I remember there was a great attempt made to maybe not directly tell people what to do in this situation for fear of being accused of being some sort of nanny state. And we're hearing different messages now.
Different messages now, joining in really what has been the tune in Europe in terms of curbing demand. So National Grid saying that energy consumption should be reduced between 5 and 6 p.m. It's called the Demand Flexibility Service, and actually people are going to be paid to cut their demand between those hours if they use a smart meter. You get more money the bigger reduction you make. It's about a couple of pounds per household, so hundreds of thousands of households will get a total of about £1 million. And the idea isn't, of course, to sit in the dark, it's just to use your kettle or load your dishwasher at a different time to spread the demand through the day to avoid the blackouts.
Lizzie, thanks very much. Bloomberg's Lizzie Burton with the latest on the energy story here in the UK. Coming up, we'll be back to earnings season for the quarter, of course, which is kicking into gear as we speak. We will take a look at what to expect. That's next. This is Bloomberg.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity can work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
I think expenses in wage inflation are going to be a problem for a lot of companies as we move forward.
The UK is in a wage price spiral, but it's unlikely that central banks are going to throw in the towel and essentially say, mission accomplished at 5%.
There's still a lot of work to do when it comes to wages and getting them down to a tolerable pace of growth that meets the Fed target.
It's not that the Fed wants fewer jobs. What they want is lower wage growth, more because they're worried about persistent inflation.
There are enough for workers to be able to get some wage increases, which they desperately need, but not enough to set off any kind of wage price spiral that will fuel ongoing inflation.
Maybe we've seen some signs of wage growth slowing, but you still have such a tight labor market that I wouldn't necessarily expect wages % inflation.
Various guests there talking about our Markets Live Pulse survey question, which asked about evidence of a wage price spiral. We had an interesting conversation earlier on with Viraj Patel from Vanda Research about the extent to which we should be looking for any clues from the labour market, given that data sometimes does lag. But wages may be a slightly separate issue, but interesting to get those thoughts. Now, it is a busy week for the earnings conversation. On the consumer side, we will see if this past holiday season has given Wizz Air and EasyJet a boost. And as Microsoft reports tomorrow, we've also got chip makers, including ASML and ST Micro, reporting this week. So for a look at the European reporting calendar, let's talk to Charles Capel, who is Deputy Team Lead for our Breaking News team. It's going to be a busy week for you then, Charles. Busy on Breaking News. Let me ask you what you've got your eyes on. I mean, I mentioned a couple of the themes there. There's going to be the consumer story and also tech, or the European expression of tech around chips.
Yeah, exactly. I think the stage we're at the moment is the consumer and the resilience of the consumer and where they are going to be spending their money. So on one hand, we have this very apparel-focused selection of companies, so the likes of H&M, the likes of AB Foods, which of course owns Primark. Now, we're going to be seeing where the consumers are trading down a little bit, and maybe those stocks could benefit a bit from people looking for value, perhaps over prestige when it comes to their apparel, and just looking to get that extra winter coat or those scarves and not worrying about necessarily where it came from. And then the other side of things when it comes to consumer is the airlines, and we have EasyJet and Wizz Air also reporting this week. Now again, if you're looking at going away this summer, you might be thinking, okay, I'm not going to fly with the premium carrier, but I'm still going to go away, my holidays aren't going to get cut, and so then they may choose to fly with the likes of EasyJet and Wizz Air. They're slightly towards the lower end of the scale. I mean, the question when it comes to EasyJet is how they've held up over the winter as well. We've had some weak snow. Wizz Air have a very important Middle East operation that we need to be getting an update on as well.
Okay, so interesting that there's two sectors where trading down is often a theme. You know, that the weakness in the consumer environment is seen as a headwind maybe for both of those, but then the message that management often give us at this time is, well, we benefit because consumers trade down to cheaper alternatives. How squeezed are consumers then? Because that's been a real worry, hasn't it? The consumer side of things, heading into recession in various parts of the world, if that is what we are heading into, that consumers will be squeezed.
Yeah, I mean, if you look at the data, I mean, the retail sales are pretty grim, and when it comes to things like consumer confidence, retail sales, it does indicate that consumers are not in a good shape, and then we also have huge amounts of credit being taken out. But then you look at some of the earnings reports, and particularly at the beginning of this year, there was a lot more optimism coming through, and I think we have seen wider optimism about perhaps a more resilient consumer, somebody who's perhaps willing to make sacrifices in terms of trading down, but not making sacrifices in terms of not spending at all. So that's potentially where they are.
Yeah, in fact, some people talking about the way that maybe the consumer market is sort of stratified or bifurcated, and you have at one end of the consumer spectrum people really struggling, and then at the other end either trading down or being a little more resilient. Charles, thank you very much for that. Charles Capel joining us from the Breaking News team. Let's get a Bloomberg First Wave News update. Top stories we're covering this morning. Here's Alice.
Hi Anna. Germany and France are warning European business will need to
on a massive scale to keep up with the US and China. Leaders of the two countries met in Paris to discuss how the EU should respond to President Biden's Inflation Reduction Act. The bloc argues Washington's plans unfairly subsidize US companies. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as officers closed in. 10 other people were wounded in the shooting in Monterey Park following a Lunar New Year celebration. Armed officers surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. A top health official in China has suggested more than 1.1 billion people have been infected with COVID since virus controls late last year. In the week leading up to this weekend's Lunar New Year holiday, Beijing's official death tally was about 12,500. The World Health Organization is urging China to release more information on the outbreak. Germany's foreign minister has suggested it wouldn't stand in the way if Poland sent Leopard tanks to Ukraine. The German defence minister, meanwhile, acknowledged for the first time that Ukraine will need battle tanks to regain territory. This as former UK PM Boris Johnson travelled to Kyiv, urging the West to double down on support for Ukraine. Global News 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna?
Yep, Alice, thank you very much. Certainly with the foreign ministers from the European Union meeting in Brussels and that tank conversation still very much in focus. Now, the Kansas City Fed President Esther George says officials don't want to raise rates by so much that policy becomes overly restrictive and the economy can avoid a sharp downturn. That's her view. George sat down with Bloomberg TV's Mike McKee for an exclusive conversation.
This is a very tight labor market, and I think unusually so in this sense. We've seen 3.5% unemployment before, but when we look at the people that are engaging in that workforce, we are still down in terms of participation compared to where we were in 2019. We see a number of job openings for every available worker. And so in that sense, all the indicators show how tight the labor market is. And again, when I go out and talk to people, it's their number one concern, the ability to find people to come to work. So I think on the supply side of the economy, we're seeing some binding constraints there that are making it more complicated, if you will, to see inflation come down in a very convincing manner.
Raise unemployment by a full percentage point, and it's about 1.5 million people who lose their jobs. Do you think there's a path to avoid that now? Do you think that maybe this is a different enough dynamic that unemployment doesn't have to rise significantly?
I think when you look so far, so spending has held up. What I'd really be looking for is to see, are some of those job openings going to come down? Will we see some of those vacancies removed as we see this imbalance begin to be addressed? So I think this scenario, can there be a soft landing, is one we would all want to see, and there are some possibilities for that. There's still a lot of money sitting in the checking accounts of households. They may hang on to that. That will make the job easier. To the extent that moves out, that may create a more persistent need to tighten. But I think you have to wait and see how that unfolds.
Why do you think Wall Street doesn't believe you when you say you're going to hold rates for a long period and you're going to do whatever's necessary?
Well, I don't know that I'm the right person to speak on behalf of Wall Street. I will tell you, we can have different horizons and different lenses through which we look at this issue. I hear a lot about recession probabilities, a lot of focus on what's going to be that peak rate. I think for me and my colleagues, the focus is really on getting back to price stability. And that is really a very singular focus right now. And thinking about what it takes to have that policy be sufficiently restrictive, not overly restrictive, to get to that point of a 2% long-run inflation goal.
Well, let's stipulate you do that. What do we see in the economy once this cycle is over? Do we go back to the new normal of low rates and low inflation? Do we go to an old normal? Do we go to a new normal? What kind of economy do you expect?
I think it'll be different. I don't have that crystal ball to really see what will it be.
That was the Kansas City Fed President Esther George speaking with Bloomberg's Mike McKee. Coming up on this programme, we'll get back to the here and now of stocks in Europe, but just 10 minutes away from the start of the European equity trading day. And some of the stocks in focus include the UK's National Grid, which has put coal-fired power units on standby today. We were hearing about this from our colleague Lizzie Burton earlier on amid the very cold weather. We will talk about that amongst other stocks in focus. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Welcome back to Bloomberg Markets Europe at 9 minutes until the start of cash equities trading. And the futures picture, well, it looks fairly muted in some locations. Maybe some gains coming through on the German market. That's where the gains seem to focus right now. Of course, we could be playing catch-up with what we saw on Wall Street on Friday. Let's take a look at some of the events that are going to be on our radar throughout this week. Today, we will hear from the ECB's Christine Lagarde, who is due to speak at an event. Of course, we heard from her last week over in Davos a few times. Must stay the course on monetary policy was the line she gave us on Friday. That certainly added to some of the hawkish language in markets, and we've seen the euro on the rise as a result of some further hawkish language from the ECB over the weekend. Tomorrow we'll have PMI data for the US, the UK and the euro area, as well as earnings from Microsoft, so the tech focus picks up then. On Wednesday is Canada's rate decision, followed by more tech with results from ASML and also Tesla. On Thursday, a lot of data coming out from the US, including fourth quarter GDP, initial jobless claims, as is traditional, and durable goods and wholesale inventories. Then moving on to Friday, we get the Fed's favoured measure of inflation, PCE deflator, that could be interesting for markets, and results from the likes of Chevron. So that's what we're looking ahead to. That's what the week ahead looks like. Let's get the stocks in focus right here, right now this morning. Tom McKenzie joins us, anchor of the European Market Open. Tom, good morning. What are you going to be watching there? National Grid to kick us off.
Yeah, National Grid, you've been talking about this, the fact that they are telling 3 of their units, coal-fired units, to get ready to add additional capacity into the grid later today because, of course, you have increased demand, frigid temperatures, -5 earlier today here in the UK, combined with the fact that wind has come off, so that renewable input has slowed, so you could see a crunch. It's the first time that National Grid have asked those 3 units, coal-fired units, to prepare for this additional supply. Also suggesting and using a mechanism as well that may pay some households to reduce their energy usage between 5 and 6 p.m. today. So just watching on the back of that story as these temperatures fall this week across the UK.
Okay, and also in focus, the technology sector for a number of reasons. We get lots of earnings out this week, but also a big focus on chips.
Yeah, this is a really interesting story, I think, given what we're hearing from the French and the Germans around the need to double down on investment, particularly in the renewable sector. We're hearing over the weekend, Wolfspeed, a German company, partnering with ZF Friedrichshafen, are planning a €2 billion semiconductor plant. It'll be one of the largest in the world, going to come online in about 4 years, supplying semiconductors to the electric vehicle industry. They are set to open this production facility, at least build it in Germany, and again, production expected to come online in about 4 years' time.
Okay, and talking of investment, National Express also winning a contract.
Yeah, winning a €1 billion contract over in Germany to operate 2 lines. The context is it's been a pretty rough 12 months for this company, according, at least when you watch its stock right down about 46% over the last 12 months. We'll see if this deal does anything for National Express. A €1 billion deal, again, 2 lines in Germany. They're going to operate until 2033.
Okay, Tom, thanks very much. Bloomberg's Tom McKenzie, European market opener. He'll be back shortly with the latest. Let's just get to the football sector, because Juventus, we're seeing could be weaker at the start of trade, considerably weaker versus Friday's closing price. Juventus saying that, of course, this is news from Friday, but post-session, a court has ordered a penalty of 15 points on the Italian football club in the standings for the current season. Juventus plans to appeal to the Sport Guarantee Board in accordance with the terms of the Sports Justice Code, but this in connection with the behaviour of Juventus previously. So we'll keep an eye on that one. That is one stock in focus. The euro broadly very much in focus this morning. The euro is stronger, 109.08, so back above the 109 level as we continue to get hawkish language coming through from the ECB. We'll hear from Christine Lagarde this week once again. We heard from Klaus Knott over the weekend talking about the need for multiple, at least 2 50 basis point hikes. So the market increasingly focused on that conversation and the contrast with the Fed. The open is up next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Does the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
A weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Staking out positions, Fed hawk Christopher Waller says he favours a quarter-point hike at the next meeting, while Class Knott sees at least 2 more 50 basis point increases for the ECB. Fading recession odds, JP Morgan sees chances of an economic downturn falling across markets. The dollar drops, with European futures marginally higher. Plus, closing ranks. Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the US and China.
So Tom, let's take a look at the futures for everyone, of course, watching in Asia and China especially. First of all, happy Lunar New Year. It does mean that major centers in Asia are closed for the celebration, so we're probably seeing less volume throughout the board. But for the moment, DAX futures and FTSE futures getting between 0.2 and 0.4%.
Yeah, some really interesting lines coming out from the investment banks then on the recession risks. We had said in the headlines, JP Morgan, with its model across 9 different assets, 7 different asset classes, pointing to a lower than 50% chance of recession. The FTSE 100 currently pointing to gains, very modest gains of about 0.1%. Morgan Stanley's Mike Wilson, by the way, coming out saying that the overwhelmingly weak macroeconomic data has not yet been priced into these markets. The FTSE 100 currently up 5 points, 9 points in fact. Spanish IBEX gaining about 10%, and over in France gains of 0.3%. More industrial action here in the UK, and of course investors weighing up the commentary then from ECB officials. Class Knott, of course, coming out saying he wants to see at least 2 50 basis point hikes going forward. And then, of course, on the flip side, arguably, the Fed officials towards the end of the week softening their tone, pointing to 25 basis points at the next meeting. And that gave a very strong rally, particularly to the Nasdaq, towards the end of play on Friday. The S&P ended up around 1.9%. Let's switch it over and see how things are playing out across these sectors then. A major week, by the way, for technology. And again, Nasdaq ending up on Friday close to 3% in terms of the gains. We'll see if that can really be sustained given the challenges across the tech sector. The futures just range bound now for US futures. Of course, much of Asia is closed then for the Lunar New Year holidays. Euro dollar strengthening, currently at 109 for the euro, again of a little over 0.5%. 109 the 10-year over in Italy, just up 2 basis points. Again, weighing up the commentary, the more hawkish commentary from ECB officials at just over 4 on the benchmark over in Italy. And Bitcoin gaining, again pointing to the modest risk-on sentiment he's done. He's getting 0.4%, just above 22,000 now for crypto, Francine.
Tom, if you look at the industry groups moving the most, first of all, we do have some losses, but they're not huge losses. Chemicals, healthcare, utilities down about 0.2%. On the upside, I am looking at technology, auto parts, real estate, banks gaining some 0.8%. And then, of course, we're looking at some individual stocks. One of the biggest losers in today's trading session, for example, is the famous Italian football club, Juventus, and this is because they got 15 points taken off their grand slab because of how they account to transfers, and I think the share price is down some 15%. So we'll look at that a little bit more in depth. Let's also get to our markets reporter, Valerie Teitel, who's looking ahead to U.S. tech earnings out this week.
Yes, Francine, that's right. I want to note that our Bloomberg Intelligence is noting that over a 9% drop in profits from the third quarter. This is going to be the biggest drag on profits in the S&P for this fourth quarter, and it's expected to shrink the most since 2016. It's notable that that's when the Fed was guiding its previous tightening cycle. But look, Wall Street has been slashing earning estimates for months in the tech sector. The profit outlook has deteriorated rapidly, but the main question, Francine, is has it deteriorated enough? Funny enough, the data compiled by Bloomberg Intelligence points that the specific tech sector in the S&P 500 will return to growth in the second half of this year. So the danger is this going to prove too optimistic? Are these analyst estimates too optimistic? As we know that the Fed is looking to hold rates at 5%. But in my estimation, they're maybe just taking a page from the rates book. We see over 100 basis points of cuts are now priced for the Fed out until March next year. And perhaps we're just a bit too optimistic that the Fed can manage this soft landing. A clear direction for the U.S. economy is still yet to come clear. We're sitting now in 2013, but a Fed pivot and a cut to neutral is what the market is now expecting.
In terms of cuts by March, of 2024. Really fascinating. Vale Taitel, thank you for the breakdown. Let's delve deeper into these markets then. The dollar weakening against most of its G10 counterparts, while Japanese stocks, with many major centres in Asia, closed, of course, for the Lunar New Year celebrations. Let's bring in BlackRock Global Chief Investment Strategist Wei Li. Wei, good morning. Thanks for joining us this Monday. Just give us the update on the team at BlackRock in terms of these recession risks. We're hearing two different narratives this morning from the likes of JP Morgan and Morgan Stanley. JP Morgan saying that they're looking across in terms of their model across asset classes. 7 out of 9 now suggesting that there is a less than 50% chance of a recession in the US. But Mike Wilson over at Morgan Stanley saying, look, the macroeconomic data is overwhelmingly weak. It isn't yet priced in.
I think the way to reconcile the two narratives is that markets are certainly pricing out a recession, right? If you look at market indicators, recessions don't seem to be on the cards. But the way that we see 2023 playing out is that recession is foretold because we're not out of the woods with inflation, especially core service inflation is still pretty persistent. So we believe that central banks, including the Fed, will have to power through and push on in terms of rate hikes and stay elevated close to peak rates for longer than what markets are currently appreciating. And that would lead to a recession.
This is what the markets just don't want to believe, right, that we'll have interest rates at 4 or 5% for much longer than expected. What will convince them?
I think as it becomes clear that actually inflation is more persistent than what markets are currently extrapolating from the last 3 consecutive data points. What we're seeing is that, of course, good service rotation is leading to headline inflation falling quite quickly, and that is our expectation as well. But the service component, the wage component, even including the shelter component, may well prove to be persistent, and ultimately 3 is perhaps the neutral. So yes, inflation will fall very quickly, but it's going to settle at a higher level than what markets are appreciating, and that will stop the Fed from actually being able to cut aggressively as what markets seem to be perceiving.
If that move from 4% on inflation down to 2% is going to be so challenging, is the view from you and the team at BlackRock. So what does that tell us about the bond market rally that we've seen? Looking at the US 10-year, currently 348, so that's essentially flat in the session today, but 348. It's been a big move into the bond markets. Has it been overdone given that view on the stickiness of inflation and the need to hold rates for higher?
We would definitely want to kind of short the long end of the government bond market, precisely because we believe that term premium needs to come back in, and also because of what you just described in terms of markets applying an old recession playbook, expecting central banks to come to the rescue of the economy, not really differentiating the fact that this recession is caused by central bank over-tightening versus previous recession. But we prefer to hide on the front end of the government bond market because of that attractive income.
So I just got back from Davos where we had some great conversations, loads of central bankers, and actually a lot of people asked me, look, was everyone too optimistic? And I don't know whether, if we look back at what happened in the last month, we didn't really know whether we'd even survive the winter. So is that the market psychology, that actually we're now, end of January, we're kind of over the worst for the energy crisis for the moment, and so that's why there's too much optimism?
I think the key here is for the moment. Certainly the warmer than expected winter has provided some relief in terms of energy crises, but also in terms of the relief rally in European assets. But we're not out of the woods in terms of energy supply constraint, and the tragic war is still ongoing in Ukraine. And looking further ahead, we continue to see recession coming, earnings not yet reflecting the recessionary environment that we are entering, which is why we would prefer to stay underweight developed market equities and prefer to stay with a relative preference in emerging markets because of the China reopening dynamics.
And talk to us about that. Before I get to that, Xinyan Kuai Le, by the way, happy Chinese New Year. So talk to us about the China component. You see growth actually above consensus, 6% for this year, but interestingly, you don't think it gets back to pre-pandemic levels in the medium term. How do you tie that into your views around EM then?
That's right. Happy New Year of the rabbits. Let's hope that the rabbit is less wild than the tiger.
It's lucky, right?
It should be, yes. I think it's shaping up so. In terms of Chinese growth, indeed, we have been above consensus for 2023 growth. Above 6% is our expectation, but the caveat there is really it's compared to a very low basis of 2022 with a 3 handle, and also tailing export tailwinds for Chinese growth. But that being our case, in terms of above consensus growth for Chinese economy, we do believe that there is more momentum to come, also in terms of what that means for global growth as well, especially as the developed world kind of enters into a recession. So if you look at the Chinese equity market rally, so far it's really been playing to a regulatory relief pattern, right? It is being led by IT, so the reopening theme and the domestic theme has yet to come, which is also why we have a relative preference for emerging market assets over developed market equities at this juncture. But more broadly, with China reopening, it means that the inflationary pressure could prove stickier and more persistent, and ultimately changing and impacting the calculus of the developed market central banks.
Wei, thank you so much. BlackRock Global Chief Investment Strategist Wei, staying with us. Coming up, European leaders fire off warnings over a huge U.S. green spending plan. So we'll have more on that story next. And this is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, breakthrough energy funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about mitigation?
Yeah.
Or are you also talking about agriculture as mitigation?
Yeah, so every emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
What's going to keep me about
This is as the economic picture down.
This is Bloomberg.
Welcome back to the Open. We are 12 minutes into the European trading day. Signs of optimism now across European equities, at least 12 minutes into the trading day. Gains of 0.4, a little over 0.4% across the European benchmark. Futures in the US pointing to gains between a tenth of a percent and 0.2% on the Nasdaq futures after, of course, that gain of almost 3% on the Nasdaq 100 on Friday. Of course, digesting commentary from Fed officials and the ECB, slightly divergent picture coming from both of those central banks. Francie.
Now, Germany and France are pushing for huge spending increase as European businesses so they can compete with their U.S. and Chinese competitors. This comes as the countries push to make their economies more climate friendly. Now, it follows a summit between the French and German cabinets in Paris over the weekend. So for more on all of this, we're joined by Bloomberg senior editor Benedict Kamel. Benny, thank you for joining us. So we also, caught up with quite a lot of the finance ministers of Germany, also the economy minister. Are they now willing, after the summit in Paris, are they willing to go full on and take on the Inflation Reduction Act that the U.S. has put in place?
Well, we heard yesterday from Scholz and from Macron that they want to respond, and how exactly they will respond remains somewhat unclear. They said that they want to, as you say, unleash spending in Europe among European companies. Will this be sort of nation by nation? Will this be an act of European unity? That part isn't quite clear yet. We heard from Scholz last week in an exclusive interview with Bloomberg. He said, we don't want a trade war with the US. So I think that's sort of where they want to get away from. They don't want sort of tit-for-tat a trade conflict. That's one thing they want to avoid. On the other hand, unleashing this spending in Europe, how much government intervention will there be? Already sort of the government side has been hollowed out over the past couple of years during the pandemic, during the energy crisis. How far are governments willing to go to support these energies? That really remains unresolved.
What about in terms of the involvement, the active involvement amongst EU states within corporations, within EU corporations to support them as they face this competition from the US and Asia?
Well, that's exactly a very sticky point. Sort of how far do you go? At what point do you run into your own competition rules? Already there's a lot of discomfort on the EU level in terms of what countries do. Germany has sort of pushed ahead in some areas over the past couple of months, in particular when it comes to bailing out energy companies. So, as I said, how far are you willing to go? There's a bit of a conundrum here for the region. They want to support these energies. We're talking about future energies, hydrogen batteries, wind and solar, so you want to be at the forefront of that. And you want to push back against the US dominance and a Chinese dominance, but at the same time, as I said, you don't want to hollow out even more the European competition laws as they exist.
Okay, Bloomberg's going to come on the latest in terms of the commitments by France and Germany to double down on their support for the renewable sector in the face of that competition, of course, from the US and Asia as well. Thank you. Now, many economists are adjusting their European outlook towards, and turns upwards, I should say, with both Deutsche Bank and UniCredit citing cautious optimism that the recession will indeed be avoided this year. That's as data improves for the continent. BlackRock, however, notes that a European recession cannot be avoided, citing continued sticky inflation readings and growing wage pressures. BlackRock's global chief investment strategist, Wei Li, still with us, very pleased to say. Let's talk about that call then, as increasingly we are hearing, whether it's European officials within the Commission itself or economists suggesting that maybe actually the Eurozone skirts a recession this year. You're a little bit more bearish on the outlook.
Well, I think when we talk about avoiding a recession, there seems to be a bit of a confusion around the drivers of this recession. People are pointing to the mild weather, people are pointing to more resilient consumers as reasons for why we might avoid a recession. But the stronger and the more resilient economies seem to be at this point, the harder it is going to fight inflation, and more over-tightening will need to be carried out by central banks in order to bring about the demand destruction, in order to fight inflation, because this recession is not caused by excess build-up in the economy as the previous recent recessions, but rather it is going to be caused by central banks over-tightening. So the more resilient economies seem to be at this point, the more over-tightening needs to happen, and the less likely cuts can actually come through later this year as priced in by markets.
Wait, there does seem to be a belief that actually markets will, or central banks will be very mindful of not on purpose pushing economies into a recession.
I think right now central banks are very focused on fighting inflation at all costs. But at some point, indeed, the focus is going to shift from the politics of inflation to the cost economics of inflation, and that's when central banks would pause. So what you're describing, Francis, is precisely why central banks are not going to go all the way to destroy destruction so much to bring inflation down to 2%. It may be okay with 3% and settling around 3%, but we really find it hard for them to start cutting when inflation is still above 3%, which is our expectation for this year.
Well, you have the short-term view and then the longer-term view when it comes to how BlackRock suggests you position. How do you look at technology within both of those frameworks at a time when we're looking at the earnings coming through this week, expectations you could see maybe a 9% drop in profits across the tech sector? Do you expect to see further downgrades? How much exposure do you want to get to technology if you have a long-term investment or a longer-term investment view?
If we have a longer-term investment view, actually technology will be an overweight in our sector allocation because it also benefits from kind of the green transition, thinking about the explosive potential that the sector can bring, and also the less carbon footprint that it will entail in comparison with the other sectors. But in the near term, precisely as we enter into earnings reporting season, as we enter into recession, and also given our expectation that U.S. curve needs to steepen to reflect a higher term premium, and also the market getting too complacent about rate cuts, we actually will be wary about entering tech at this point. But if you have a longer term horizon, start building into those positions because there are value opportunities out there.
Wei, thanks so much for joining us. Wei Li there, BlackRock Global Chief Investment Strategist, joining us this morning. Now, coming up, Ken Griffin's Citadel rakes in a historic profit haul, outperforming its peers by a large margin. More on that next. This is Bloomberg.
More activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets. This is one of the hardest but most rewarding problems that humanity can work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Welcome back to the Open, everyone. 22 minutes into the European trading day. Tom and I are joking. There's quite a lot of football news. And yes, it's not only football news, but it's an Italian club that's being slammed. Dollar weakening against, most of the G10 currencies. Many major centers in Asia, of course, closed for Lunar New Year. So overall, we're going to see probably thinner trading volumes. A lot of European stocks gaining some 0.3%.
Okay, I'll give it to you. Juventus just about pipping the news that Arsenal pulled off a 3-2 win versus Man U over the weekend. Let's get to what's happening in the hedge fund space then. This is really fascinating. Ken Griffin's Citadel made a record $16 billion, just $16 billion in profit for clients last year. That is the largest ever return for a hedge fund. Joining us now is Bloomberg's markets reporter, Barry Titel. How did they pull it off?
monumental, Tom. 38% return, and that follows on a 26% return last year. Now, to me, this is saying that the multi-manager model that Citadel is running is really here to stay. They have a very diversified set of strategies that they run under different pockets of portfolio managers. And this model, which really has only come around in the last decade, is a huge departure from the bigger hedge funds of the past, which were always driven by big CIO names, using a flashy portfolio name to attract capital, whereas this is very different. This has caused a huge consolidation in the hedge fund industry as these big names pull big macro traders, fixed income traders, equity traders all under one envelope. And it's really enabled Citadel to capture on the big move in bonds and FX and be able to stay nimble because they can direct capital, they can use an asset allocation very quickly in terms of pulling capital from an equity manager and giving it to a bond or an FX manager, which as we know was very key last year. If you weren't exposed to these moves in fixed income, these moves in FX, you weren't going to hit those double-digit returns. But to me, this means that consolidation in the hedge fund industry is here to stay.
Yeah, if you're big, you can make some of the greatest trades ever. If you're smaller, a little bit tougher. Valerie, thank you. Valerie Keitel, our markets reporter. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Activist investor Elliott Management says that it have made a substantial investment in software giant Salesforce. Bloomberg understands Elliott's stake is worth a multi-billion-dollar sum. The investor is known for seeking board representation and pushing for strategic changes. Morgan Stanley has cut CEO James Gorman's compensation by 10% for 2022, a year which saw profits tumble and shares sank. The package includes $1.5 million in salary and a $7.5 million cash bonus, with the vast majority of the total coming in the form of shares. The cut leaves Gorman's total compensation at $31.5 million. Juventus shares fell as much as 15% on Germany's Tradegate after authorities penalised the Italian football team because of how it accounted for player transfers. The 15-point deduction sees Juventus slide to 9th place in the Serie A ranking in Italy. That means the side may now miss out on playing in the European Champions League. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Let's get back to Francine's favourite story, which is Juventus Football Club being hit with a 15-point fine. This is for allegedly false accounting around player transfers. Importantly for Juventus, Francine, this means that they are likely to miss out then on a spot in the Champions League.
This is not right. This is like the worst news. I'm a supporter.
Of course you are. I should have reframed that.
This is like a disaster
for us. But you're fascinating what's happening with Juventus. A big hit. If they don't make it to the Champions League, obviously a lot of money there. And so hence the move that we've seen in the stock price. Down about 15%, suspended on the back of this news. We'll continue to watch this for you. They are going to appeal, apparently, Juventus, to this penalty that they've been hit with. Of course, they are part of the Serie A, which is the top league in Italy. And it moves them from 3rd place to 10th place. We'll continue to keep across that story for you. Right, coming up. End the tax war and prioritise the UK's green growth. That is what the Director General of the CBI, the Confederation of British Industry, is arguing for. That, of course, as the Europeans and the US double down on their commitments around green technologies. We'll get more analysis after the break. This is Bloomberg.
Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery, it tells you where the charging stations are, it tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we use that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people.
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. Staking out positions, Fed hawk Christopher Waller says he favors a quarter-point hike at the next meeting. Class note here in Europe sees at least 2 more 50 basis point increases for the ECB. JP Morgan sees chances of an economic downturn falling across markets while the dollar drops. European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warned that European businesses will need to dramatically boost spending to keep pace with the US and China. So stock markets a little bit more subdued because of Lunar New Year.
Yeah, and certainly across the European benchmark, pairing some of the earlier gains, as you say, major markets, of course, in Asia closed for the Lunar New Year, predominantly, of course, Hong Kong and mainland China amongst the largest. But you're seeing very modest gains now of about 1/10% across the European benchmark. Again, weighing up, as we've said in the headlines, what is becoming a divergent picture, it seems, from officials from the Fed, suggesting 25 basis points for the next hike versus ECB class, not the hawk there, saying he wants to see at least 2 more 50 basis point hikes. That's playing in, by the way, to strength for the euro, currently trading the single currency up 0.4% and just short of 109. The DAX getting 0.1%, the FTSE 100 here in the UK, industrial action again, ambulance workers going on strike, just gaining 9 points, 7,780 for the FTSE 100. Let's have a look at how things are playing out across sectors then. Technology was the barnstorm on Friday out of the US, the Nasdaq 100 closing just shy of 3%. This week will be a major test, though, a stress test of that sector when earnings come through. Top of the list then across your sectors here in Europe, picking up on the gains from the US is technology, getting just shy of 1%. Base resources also up. There's been a bit of a turnaround in terms of the pricing on oil. It's now gaining. In fact, let me just double check on that. Down, in fact, I should say, Brent's down 0.3%, but you're seeing strength in copper and iron ore. That is what's playing into base resources, gaining 0.5%. But you do have about 6, 7, 8 sectors currently in the red, led by chemicals, down 0.8%. So that's a picture across the European equity markets. A little touch on the euro there at 32 minutes into your trading session, Fran.
Now, the Director General of UK Business Group, the CBI, says the country's ruling Conservative Party should stop fighting itself over tax and invest more on green energy. Well, joining us now is Charlie White-Thompson. He's Chief Executive Officer of Saxo UK. So thank you, Charlie, for joining us.
Thank you.
We had quite a disaster weekend for the Prime Minister. He was fined over not wearing a seatbelt. The chairman of the Conservative had a tax bill. There's a penalty, and there's a million other things happening in Westminster. Is that a distraction? Is that why we don't have a growth plan that investors like?
I mean, I'm sure those 2 points are distracting both of the individuals. I mean, it's not a headline that you want to be reading about. But I think at the heart of your question, it's a good one. And I've been doing some thinking about this. And effectively, my view is the UK is a publicly traded company. If you have £2.5 trillion worth of debt,
you are a publicly traded company, you have bondholders, or shareholders and bondholders, whichever way you want to look at them. And I think, therefore, you need to have a growth strategy. It cannot just be high tax. It cannot just be basically a managed decline.
Are you getting any sense that there is a growth strategy that has been formulated by the Chancellor and the Prime Minister? Are you feeling any optimism that that is going to come to the fore?
I mean, if we carry on with the analogy about the publicly traded companies, so you don't have a Prime Minister, you have a CEO, you don't have a Chancellor, you have a CFO. So that's the way I think about it. And I think that there are 5 points that are being put forward. But I think we need to double down on this because it cannot just be about tax. And I think also it's very important that we debate what I call the sacred cows too. If you are a publicly traded company, you debate sacred cows. You have to be able to do that if you're going to push on. Otherwise, I think it's very difficult. You know, we are an aging population. The demographics don't look that great. It cannot just be about higher taxes. We need to debate these sacred cows, and we need to have a clear and well-delivered growth plan. But it's not about recklessness.
But why is it so difficult to have one? So the UK Business Secretary was in Davos last week. He laid out a strategy of growth, asking investors to come in, saying it's a small, open economy. You know, there's a mismatch. Are people still scarred of what happened in the autumn? Or does it take longer for them to get back on their feet?
I mean, I think people are definitely scarred from that September budget, and I think that what happened there is that it wasn't well thought out. There were many good things in there. Growth is a good thing. Lower taxes are a good thing. But I think it needs to be better delivered than it was. And for me, are we a value company or are we a growth company? And I would encourage us to look towards the growth company because I think that's the way you basically inflate your way out of this and you deliver on all the aspirations that this country wants.
Charlie, what are the sacred cows that you want to take to slaughter?
I mean, the sacred cows are, we should start with, number 1 is national health, number 2 is the relationship with Europe, number 3 is the planning laws, number 4 is productivity. The list goes on, and these are the debates that we should have.
Productivity is extremely hard to manage and to get better. So what would you do to fix productivity?
I mean, none of these things are easy, but I think that we need to get these on the table and we need to think about how we deliver on them. There is no, I mean, if there was a silver bullet to dealing with all of these issues, then I'm sure people who are much smarter than I would have dealt with it. But those are, if you ask me the questions, what are the first 4 things that come to my mind? Those are them.
Talk to us about how you want to position and how much exposure you want to have to UK assets. Is it equities? Are you more convinced that maybe gilts is something you want to have in the portfolio? The FTSE 100, of course, relative outperformer last year. How far do you want to go down the risk spectrum? Is the 250 looking attractive?
I mean, the way I view investing is it's a multi-asset world. So you and I, Tom, we've spoken about this in the past. We've spoken about the Goldilocks economy, where effectively we had an overly stimulated market in the form of QE and low rates. And basically what that did is that gave people a full sense of security. Moral hazard's a bad thing. It gave people a full sense of security on how easy it is to make returns in financial markets. It's not easy. And therefore I believe in multi-asset. I believe in the ability to be able to trade bonds, the ability to be able to trade FX, the ability to be able to trade equities. And within the UK, it's not just about buying UK. It's about being able to have access to global instruments, and I said it the last time, I'll say it again, is that if your wealth manager doesn't provide you with these tools, then you should consider, do I have the right wealth manager?
Yeah. But Charlie, just on the point of Europe, we are seeing from all sides of the aisle wanting to be closer to Europe. What kind of relationship do you think the UK will have with the EU at the end of this?
I think we should be close, but I think that the country voted to leave Europe, and therefore I think that it's my opinion that people need to get behind this and we need to take advantage of all the advantages we have. So if we think about ourselves as a publicly traded company, what are our advantages? How can we do this? How can we best position this country going forward? These are the big questions. These are the big questions to me. I'm not talking about isolation, I'm just talking about taking advantage of our skills and our skill set, which is not a bad thing.
And it's kind of the longer term view. As we focus on the here and now, some of the economic data has actually come in slightly higher than many had expected. Our own team at Bloomberg Economics last week saying, what we're feeling a little bit more optimistic about the UK's growth trajectory this year. What is your assessment of the macroeconomic outlook for the UK?
I mean, overall, globally, it's been a good start to the year. So you've seen good stock markets, particularly in Europe. I thought Davos was a very positive affair. So that was about stock markets, that was about energy prices lower, That was about China's policy on COVID. That's about the big policy coming out of the US on green. And so therefore there are, I call these green shoots, there are green shoots, and we need to build on them, and we need to encourage them, and we need to stimulate them. But we're not out of the woods yet, and when I say that, I say the enemy number one for me, we said this the last time we spoke, is inflation. And with inflation at 10.5%, when your target is 2%, if you lift the bonnet on that, you are seeing things like food inflation up 17 months in a row. The last time we did that was in September 1977. We need to deal with that if we're going to push on.
All right, Charlie, thank you so much for the insight. Charlie White-Thompson there, Chief Executive Officer of Saxo Markets UK. Now, this is a picture for Juventus. It hurts me to say it. First of all, I am reminded on an hourly basis that it is a penny stock. Yes, it is. So shares were to 29 euro cents. Now they're about 30. Again, from 33 euro cents. So these are, very, very small changes that make a huge difference because it's down some 12%. And this is on the back of authorities in Italy really penalizing Juventus, one of football's greatest a long time ago. Now they're in a bad league, but they did cut its point standing because of how it accounted for player transfers, and that's really hurt, of course, the expectation of them winning anything at all. The share price down 11%. Coming up, the real estate run is set to spread from housing to commercial markets, also from London and Frankfurt to the rest of Europe. So we'll talk more about real estate next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
When news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Welcome back to the Open, everyone. 42 minutes into the European trading day. For the moment, we're holding on to most gains. CAC 4 turned a little bit, pretty much flat, and then the big story is, of course, what's happening in currencies with the dollar declining. But overall, European equities are a little bit better than they were last week, Tom.
And one sector that remains in green, real estate up 0.6%. We're going to stay on that topic because European real estate is actually experiencing its highest stress level in decades. That's according to recent research. Bloomberg has compiled data showing that around $175 billion of real estate credit is already facing repayment headwinds in both housing and commercial markets. To get the context and analysis, let's bring in Nicole Lex from Bayes Business School, Senior Research Fellow. Nicole, good morning. Thanks for joining us.
Good morning.
Let's start there then. How problematic is this? We're hearing now reports that maybe commercial lenders, or at least lenders, are not prepared to lend on commercial real estate. UK commercial property values have fallen 20% in the second half of 2022. How dire is the picture?
Yes, what we see with our survey, and we are now restarting talking to all the lenders, and we speak to 100 lenders throughout the year, it really shows that because their risk costs have gone up for commercial real estate, specifically because the credit quality has declined, they are definitely less willing to look at new lending. I mean, there will be a lot of activity looking at refinancing loans, but looking at new loans, new borrowers, there's going to be less liquidity and appetite.
So are we going to see, Nicole, actually some companies going bust because of this?
Well, there is still a lot of equity in the sector, so we will see obviously developers will be the first ones, or amongst the first, who probably run into trouble because they have to really complete developments, and if they run out of financing or they hit with really high financing costs, they run into delays, and then that obviously could lead to some insolvencies on the developer side. Other companies, like property companies, REITs, they have a lot of cash, but they will see their returns really decline and even go into negative returns.
Is this an orderly unwind, or are we starting to see evidence of a disorderly unwind?
Well, depends on how disorderly and how you define disorderly. Our prediction is that we will see some unwinding, but to a lesser extent than in the previous crisis during the GFC in 2008-9. How deep or how much the decline or how much the distress will be, whether it's more or less, will also depend on how the economy is going. If on top of it we see low retail sales, less consumer interest in retail, so then retail assets are going down. If people are not going back to offices, office sector rental decline, then again offices are going to do worse. So it depends a bit on the combination. And I guess we have a lot of risk factors right now, uncertainty in the economy, that there could be some more problems coming ahead.
So, Nicole, of course, if you cannot delay refinancing, this is a huge issue. Who has most to lose? Is there a part of the market that looks most vulnerable?
Yes, that's a very good question. So obviously, exactly, the refinancing is a problem. So what we've observed over the years with our data is we expect to see about 20 to 25% per year on a rolling basis to refinance of all the sort of loans. And so that is a significant amount. And obviously, who is first hit are those that they haven't hedged. That's a key problem. I mean, some might be still fine if you have your interest rate is hedged, and until a certain amount you can delay the refinancing, and you can delay the effect of being possibly hit by really high refinancing rates right now. So everything that's floating rate and coming up for refinance, that's going to be problematic. And again, that is development finance is usually short term. Any bridging finance, anybody who has used intermediate solutions like bridging and mezzanine finance needs a quick solution, and they're going to be the ones in more trouble.
Are you seeing, is this an opportunity for cash-rich buyers? Are you starting to see cash-rich buyers, whether here in the UK or based outside, I think the Middle East, elsewhere, coming and swooping in?
Yeah, I mean, absolutely. I mean, where there is a loss on one side, there is an opportunity for other people, obviously, and as property values correct, it's a brilliant time. At the same time, if you have equity and you can buy at the right price, and this is where the opportunity is. Whether there is going to be a lot of Asian buyers, considering now the problems that are happening in China, there's always a foreign investor group that will come, I think, into the UK market. You will see US investors as well that are typically coming at this time round when rates are really interesting to them. Europeans probably less so, they will stay in their home markets. So it depends on the global capital flows, but people will pick up opportunities.
Nicole, thanks so much for joining us today. Nicole Lux there, Senior Research Fellow at Bayes Business School. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Germany and France are warning European business will need to unleash investments on a massive scale to keep up with the US and China. Leaders of the two countries met in Paris to discuss how the EU should respond to President Biden's Inflation Reduction Act. The bloc argues Washington's plans unfairly subsidize US companies. A top health official in China has suggested more than 1.1 billion people have been infected with COVID since virus controls were abruptly dismantled late last year. In the week leading up to this weekend's Lunar New Year holiday, Beijing's official death tally was about 12,500. The World Health Organization is urging China to release more detailed information on the outbreak. Incoming New Zealand Prime Minister Chris Hipkins says he will prioritise the economy as a recession looms and may drop some of Jacinda Ardern's policies. Hipkins is seeking to win back the political middle ground ahead of an October election, with his Labour government trailing in opinion polls. He says he's heard the message from some voters that the government is doing too much, too fast. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as the officers closed in. 10 other people were wounded in the shooting at Monterey Park following a Lunar New Year celebration. Armed officers surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Okay, Alice Atkins in London, thank you. Coming up, Bloomberg has learned that an activist hedge fund, not just one activist hedge fund, a very prominent one, has taken a big stake in Salesforce. We'll bring the details on that scoop and what it could mean for Salesforce going forward. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
One's going to keep reading World Cup. This is a three.
As the economic picture does.
The OK's getting ready today.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open. 52 minutes into your European trading day this Monday morning. Gains of 0.2% across European equities. Morgan Stanley's Mike Wilson saying that the macroeconomic data is overwhelmingly weak and has not yet been priced into these markets. The futures are flat in the US after a very solid run on Friday. The Nasdaq 100 closing up nearly 3%. And as a result of that, your technology is the lead sector here in Europe, gaining 1.2%. Francie.
Now, activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands that Elliott's stake is worth a multi-billion-dollar sum. Now, the investor is known for seeking board representation and pushing for strategic changes. Well, joining us now is Bloomberg technology reporter Aggie Cantrell. Aggie, great to speak to you. It's the chief executive's worst nightmare to have an activist investor like Elliott on your back, especially as Salesforce is going through huge changes.
Yes, exactly. So we're seeing at Salesforce, we've seen massive changes. Even in the last couple of weeks, we've seen them cut staff by 10%, say that they're reducing office space. But we've also seen that the company more broadly has had a real issue with keeping that pandemic market cap. In 2021, its market cap went up to $300 billion, and now it's around half of that. And so what we're seeing from this move now is essentially a need to translate Salesforce's performance into market performance, and that's what's going to happen with Elliott coming on board potentially. We're seeing as well that that people have left the company. Top executives, including the co-CEO and the former founder of Slack that was brought on board, have both left the company in recent months. So it's part of a potential plan to turn around the company and actually make sure that its market cap gets back up to what it was in 2021.
And it's a big stake from what we're hearing. And they came out with a statement pretty supportive of Benioff. How concerned should the team at Salesforce be?
I think that's a crucial part of it, Tom, that essentially Benioff is seen as a steady hand at the company. And we've also seen that even in that statement, Elliott was making it clear that they thought that he was good for the company. And so, but we have also seen in the past when Elliott has taken stakes in, for instance, PayPal and Pinterest, the market has seemed to like that. They see Elliott as potentially an investor that can help push a company's performance for its shareholders. And so we've seen when we've seen recent moves also in other companies like PayPal and Pinterest, we've seen that perform well on the market.
Aggie, big week for technology. I jumped in there, Francis.
Oh, sorry,
You've got a
go
question.
ahead.
Well, we'll maybe do a double act on this one, Aggie. We're very keen to talk to you about this. So, of course, a big week in terms of the earnings coming through from the tech sector. What are you and the team going to be looking for?
I think what we're going to be looking for is going to be looking for more communication post these recent job cuts. These job cuts have sent shockwaves through big tech. We've seen them in so many different companies now, but also we've seen the big players getting in on the job cuts, including Google only on Friday last week. And so what we're going to be expecting is some more communication of what these job cuts actually mean for the growth of these companies. Is this just a question of them overhiring during the pandemic, or are there real strategic moves to be taken in the next couple of weeks when it comes to where big tech is going to be able to navigate a potential downturn?
Okay, Bloomberg technology reporter Aggie Cantrell in Berlin. Thank you very much for the update and preview, of course, of a big week for earnings out of the tech sector and, of course, that activist investment in Salesforce. Just checking on your markets then, European equities currently posting gains of 0.2%. Futures are flat in the US, of course, it is the Lunar New Year here. Holiday in much of Asia, so mainland China and Hong Kong closed, but across the MSCI, Asia-Pacific, gains of 0.5%. Euro-dollar rallying 0.4%, 109 on the back of pretty hawkish comments from ECB officials out of the Netherlands, pushing and stamping their hawkish narrative on these markets, Francie.
That's it for the European market close. Well, open rather. Surveillance early edition is up next. This is Bloomberg.
a digital-first approach to the future work is where the industry and all companies will be heading.
Let the future work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing? When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
A weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance Power.
This is Bloomberg. Surveillance, early edition, with Francine Rockwell.
Well, good morning, everyone, and welcome to Bloomberg Surveillance, early edition. I'm Francine Rockwell here in London. Here's what's coming up on today's program. Fed hawk Christopher Waller says he favors a quarter-point hike in the next meeting, while Class Note here in Europe sees at least 2 more 50 basis point increases for the ECB. JP Morgan sees chances of an economic downturn falling across markets. The dollar drops with European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the US and China. Now, first thing is first, let's check out the markets. So we are probably going to see thinner volumes than usual because of the Chinese New Year. So a lot of financial centers in Asia will be closed. European stocks pretty much unchanged, maybe gaining some 0.2%. We're seeing energy, of course, one of the biggest gainers in today's trading session. The dollar index, 1,222. If you look at euro dollar, that's probably the most interesting currency. This, of course, is on the back of some of the differentials when it comes to interest rates. The dollar actually slipping. Stocks, though, are gaining after we had a lot of Fed speakers maybe sounding a little bit more dovish than usual. Let's also get the European map. Again, there's not a huge divergence of the fortunes of some of these European stocks. The FTSE mid down 0.2%. Juventus, I know it's a penny stock, but it's down some 10% after it lost quite a lot of points because of accounting irregularities. The picture for the FTSE gaining 0.2%. So there has been muted trading in Asia. Many markets closed, as we were saying, for the Lunar New Year. So that's the very latest on what we're seeing. However, Japan stocks did close up. Prospects for slower policy tightening by the Fed lifted investor sentiment. Now, for more on all of this, we're joined by Luke Hickmore. He's investment director at Aberdeen. Luke, good morning. Happy Monday. What's the week looking like?
Difficult, I think. It's easy to get sucked into these equity rallies and bond rallies that we've been seeing over the last few months. But we start seeing earnings season kick off in earnest this week. A lot of tech earnings coming out of the US as we go through the week. And I think that might temper some of the enthusiasm we've seen for risk over the last month, 2 months in particular.
So, Luke, talk me a little bit about what we've seen overall. When you look at some of the concerns out there, I don't know whether it's the market not understanding what the Fed will do and how aggressive it can be.
So, we've still got different Fed members telling you different things at 25 basis points from one, 50 basis points from others. I think they are still keen to push those rates up and actually get the US economy into negative growth, possibly even recession over the next 6 months or 7 months. And the market seems to be kind of ignoring that a little bit and saying, look, we want to buy, there's lots of cash on the sidelines, let's get it involved, let's move on and actually get some growth going. But, the Fed's still there, it's still going to hike, companies are going to find their earnings coming under increasing pressure as the year goes on. I sometimes think we forget that lower inflation does not mean lower prices. Consumers are still going to be finding the year pretty hard. And that all needs to come out, I think, over the next month or two to really reset the market to a much more better valuation level for the risks that we face going forward, whether those are inflation or interest rates or war risks still in Ukraine, of course.
Yeah. So, Luke, where do you see the most interesting part of the market? Is it currencies, or do you actually play some of the equities? I don't know if it's on the back of earnings or margin squeezes.
I'd be nervous chasing equities here. I think investment-grade credit is probably a decent place to be, but even that short-term feels a little bit expensive, and I'm an investment-grade credit manager, so it's always easy for me to say my market's brilliant. But I think just short-term, even that looks expensive, particularly in dollars and euros. A little bit better value maybe over in sterling, and you can find pockets of value out in the Far East, as we've seen with our emerging market teams. But even that needs to kind of correct a little bit to reflect the risks that recession really is coming, even though that seems to be fading off the radar a bit.
Luke, let's also bring in Heather Burke from our Bloomberg EvLive team. Heather, good morning. Thanks so much for joining us. When you look at classic mode and actually what's happening in the ECB, are we going to see more interest rate differentials, and what does that mean for currencies?
Definitely. On the one hand, you have the Fed, like Christopher Waller, saying, okay, we're 25 basis points look in, we're seeing some slowdown, maybe that Fed pivot's coming. On the other hand, in Europe, in the euro area, you've had all these central bank speakers from Klaus Knott, Olli Rehn saying, okay, we are not where we need to be, we need to keep hiking. 50 basis points seems pretty baked in for the February 2nd meeting. And so, we are seeing this differential. At the same time, the euro area economy, still there's a lot of soft patches, but the energy crisis has eased. And, we're seeing maybe the worst case recession scenarios have been averted. That being said, the ECB doesn't want to take the foot off the gas. They want to put rates in restrictive territory.
Luke, what does that mean for your expectations of what the ECB can do? Again, there was a Bloomberg story, citing sources last week saying that we could see, the end of the 50 basis point hikes, but I don't know whether that deals with inflation the correct way.
It's not the only thing we've got to worry about with the ECB as well, of course. The 14 to 16% that they own in the European corporate bond market needs to get unwound as well. So it's not just these rate hikes that we've got to get through, it's the QT that we're going to be seeing after that, and a massive amount of sovereign issuance that, close to 500 billion net by most people's estimates over the rest of the year from Europe as a whole. So, ECB's not just there on the horizon as the concern for investors in Europe. And I think, again, the euro seems to be running ahead of itself a little bit. The fall off in the dollar, in particular the DXY, down to the levels we saw last April, seems too far right now for those risks that we see going forward. And Heather, I love the EvLive blog, by the way. Some great notes this morning on the euro.
So congratulations, take it. It is a wonderful blog. Heather, what are you focusing on next, actually, when it comes to currencies or even bonds in Europe?
I look at the whole story overall. You've had European outperformance. I'm a stocks geek, and you've really seen European stocks. They had one of the best quarters ever in dollar terms versus the S&P 500 in 4Q. You've seen that outperformance continue. I think part of that's the overall ECB, the hiking story, the economy and energy avoiding these worst case scenarios. I'm going to really be looking at earnings as a kind of make or break for stocks on both sides of the Atlantic. You had Simrise out today, a chemical company, and they've had some margin issues. They're down, and that is a really big banana peel for stocks on both sides of the Atlantic. The U.S. this week, we're going to start to see some of those big tech readings with Microsoft and Tesla, and that comes with a lot of job cuts. Are they going to kind of be able to produce the same kind of growth that kind of seems baked into some of these stocks?
Look, what do you do with a lot of the tech stocks and names?
I think it's tough. I think, you could look at this as a long-term opportunity to just ease in a bit of dollar cost averaging into what are some great names, but you want to be, I think, probably at the top of the pile, the quality names in that space, the Microsofts, the Google Alphabets, the Masks, those kind of businesses, rather than kind of chasing the smaller players in those markets who I think are going to find it really hard. I agree on the margin side completely, and we are going into a season in Europe in particular where we're going to be talking about earnings, and we're going to be talking about bulk negotiation of wages across Germany in particular, which could be 10% this year. So yeah, margins all year long.
Great, thank you both for joining us. Luke Hickmore, their investment director at Aberdeen, and Heather Burke from Bloomberg Markets Live. Now, this is the picture overall for, Salesforce. Hedge fund Elliott Investment Management has taken a substantial, and when I say substantial, I mean an activist stake in Salesforce, making a move after layoffs and a deep stock swoon at the enterprise software giant. Now, on the back of Elliott's investment, stock price is gaining some 4%. Elliott, one of the most aggressive, activist shareholder, often pushing for strategic changes, often seeking board representation, we understand took a multi-billion-dollar stake in the company, and of course the market cap of Salesforce now $151 billion, down from a peak of more than $300 billion back in 2021. Coming up, European leaders fire off warnings over a huge U.S. green spending plan. We'll have more on that story next, and this is Bloomberg.
Agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come out. So that's the package that you're talking about mitigation? Yeah. Or are you also talking about agriculture as mitigation?
Yeah, so every area of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. About 4% of energy generation is wind and solar.
Do you think today it's easier for a black entrepreneur to start a company, or no more easy than it was 20 years ago or 30 years ago?
If it were easy, you would see more Bob Johnson, more Michael Jordan, more Magic Johnsons, and Oprah Winfrey's and the like.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Mpatswe here in London. Now, France and Germany are pushing for huge spending increases so European businesses can compete with US and Chinese rivals. It does follow a summit between the French and German cabinets in Paris over the weekend.
Es ist notwendig, dass wir
it is necessary that we handle the inflation reduction aid and formulate a European answer. Firstly, we have to make sure that, as a European Union, we are not treated worse than neighboring countries such as Canada or Mexico. And it cannot be accepted that the many local content regulations that are in there cause discrimination of European businesses and their activities in the U.S.
Unternehmen bei ihren Tätigkeiten und Aktivitäten in den USA bedeuten.
Now, for more on all of this, we're joined by Bloomberg Senior Editor Benedict Kamel. Benny, thank you for joining us. So tell us a little bit more about what was actually discussed at the summit in Paris.
So the summit between Macron and Olaf Scholz, the German Chancellor, in fact the entire cabinet of Germany flew over to Paris for this. And one big topic was, how do you counter President Joe Biden's Inflation Reduction Act, the IRA, which is essentially a $500 billion sort of act to get future technologies, future energy off the ground, do more sort of buy American and create a huge counterweight to what's happening in Europe and what's happening in China. There is that concern, we heard it just now from Olaf Scholz, saying we want to make sure there's a level playing field, we want to make sure that we're not treated any worse than the direct neighbors of the US, Mexico and Canada. But how do you do that? You can either go the official complaint route down the WTO. That'll probably take years, and it's unclear where it'll take you. And what they've now decided is they want to create something similar over here, a similar push that will keep companies here in Europe, because there is a concern that companies will look at what's happening in the US, they will move business over there, and during times of sort of economic difficulty, that's the last thing you want.
So, Benny, is this a sign that EU governments are moving towards more active involvement in companies?
It sounds that way, but it's unclear how exactly that would shape out. Would it be a universal effort across Europe? Would it be country by country? We've already had a lot of sort of countries doing their own thing. In Germany, we had efforts to stabilise the energy sector, to stabilise the aviation sector, and so on during the pandemic, but also now during the energy crisis. And you want to make sure that not every country does its own little thing, but that there's a universal effort. So how exactly that'll work out, that is unclear. France and Germany being the two dominant economies coming together, that'll probably go a long way, but there's a lot of left unknown in the detail. There are further meetings planned today by the foreign ministers, there are meetings by the leaders in the next couple of weeks, so the intent is there, but how exactly that'll shape out and how you make sure that you don't hollow out the European competition laws, that remains unresolved.
Benny, thanks so much. Bloomberg's Benedict Kamel, they're joining us on this very latest summit. Now, Ken Griffin's Citadel made a record $16 billion profit for clients last year, the largest ever return for a hedge fund. Well, joining us now is Bloomberg's markets reporter, Valerie Teitel. Valerie, I mean, the numbers are incredible. $16 billion profit, $12 billion in fees. And it does seem like you're either Millennium or Citadel and have a very divergent, different strategy, and you're really killing it. Or you're like Rockhouse and Brevin Howard, and you did for bonds, and you also did very well.
Yeah, it's really all about this multi-manager model, which you mentioned a lot of these big hedge funds are running now, Citadel, DE Shaw, Millennium, which allowed them to return these just incredible numbers last year. The multi-manager model allows them to have a wide range of strategies across different assets, and each of these teams have a niche focus and a specific trading style. And then it allows, Citadel in this case, to allocate capital to within the fund to these specific styles which they think are going to be successful. Last year, it was all about being exposed to movements and bonds and FX, and if you didn't have that in a big way in your portfolio, you were going to miss out. But this is all overlaid with a risk management approach that allows them to navigate from having specific blow-ups under one trader. It's diversified, and it's showing it's going to be the model for the industry. It's really taken the baton from the equity long-short funds of the past. The tech bubble bursting really showed a lot of weaknesses in their model, and a further shift away from the single manager models of the past. It's no longer going to be
unless you're a macro. If you're a macro, if you're Brevin Howard and Rockhouse, then you've done also pretty well shorting some of the bonds.
Yeah, those guys did extremely well last year. But the thing about that model, Francine, is their assets under management is in some way capped right? These multi-managers can have a huge array of assets. You know, Citadel runs over 60 billion, and it's hard to see that being run under one specific manager in a macro model.
Valerie, thanks so much. Valerie Titel, our Bloomberg Markets reporter. Coming up, a UK business group warns Rishi Sunak's government what he needs to focus on for green growth. So we'll dig into that story next. This is Bloomberg.
more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets. This is one of the hardest but the most rewarding problems that humanity can work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So the UK's ruling Conservative Party has been told to stop fighting with itself over tax and prioritise green growth. Now, the warning shot has come from the Confederation of British Industry, a prominent business group. Well, joining us now is our UK correspondent, Lizzie Burden. Lizzie, first of all, tell us, good morning, tell us a little bit about this call by the CBI to push green investments in the UK.
Well, the US, of course, has got its Inflation Reduction Act. Last week, we heard from Brussels calling for unprecedented investment into clean tech. So this is the CBI telling Britain to step up to the plate. You've got Tony Danker in his speech this afternoon calling for deregulation and for state funding. And of course, he's not the first to call for it. You were in Davos last week. You spoke to the Shadow Chancellor, Rachel Reeves. She said, don't carp on the sidelines about what others are doing. Get on with it yourselves to the government. And in fact, a government-commissioned report by the former Tory Energy Minister, Chris Skidmore, earlier this month also said that net zero is the growth area of the 21st century, but it's the inertia at the moment that's holding back jobs and investment. And actually, the CBI's research today shows that by 2030, the UK will have lost the value of £4.3 billion billion in terms of battery production and hydrogen market share. So this is something of an international green arms race.
At the same time, it's cold. It's very, very cold. There's like this, wave that we probably brought over from Davos here in the UK. Does it mean that we're going to use more coal?
Well, it might have done. Overnight, National Grid had asked for 3 coal-powered units to be fired up, to be put on standby, because you've got freezing temperatures and low wind power, so more demand and lower supply, but actually National Grid has stood down the units. What's interesting, though, is that people are still going to be paid to reduce their consumption between the hours of 5 and 6, peak time, and so it shows that the UK is getting into line with the rest of Europe in terms of not just using supply-side policies, but also demand-side.
Lizzie, thanks so much. Lizzie Gordon there with the very latest on the UK. Now, we'll be covering all things UK every week on Thursdays, 9:30 a.m. in our half-an-hour UK special. Now let's get straight to the Bloomberg First Word News. Here's Alice Atkins. Hi, Alice.
Hi, Francine. A top health official in China has suggested more than 1.1 billion people have been infected with COVID since virus controls were abruptly dismantled late last year. In the week leading up to this weekend's Lunar New Year holiday, Beijing's official death tally was about 12,500. The World Health Organization is urging China to release more detailed information on the outbreak. Germany's foreign minister has suggested it wouldn't stand in the way if Poland sent Leopard tanks to Ukraine. The German defence minister meanwhile acknowledged for the first time that Ukraine will need battle tanks to regain territory. This as former UK PM Boris Johnson travelled to Kyiv, urging the West to double down on support for Ukraine. Incoming New Zealand Prime Minister Chris Hipkins says he will prioritise the economy as a recession looms and may drop some of Jacinda Ardern's policies. Hipkins is seeking to win back the political middle ground ahead of an October election, with his Labour government trailing in opinion polls. He says he's heard the messages from some voters that the government is doing too much, too fast. California police say a man who killed 10 people on Saturday night at a ballroom dance club east of Los Angeles killed himself as officers closed in. 10 other people were wounded in the shooting in Monterey Park following a Lunar New Year celebration. Armed officers surrounded a white van about 50 kilometers from the scene of the attack before the suspect shot himself inside the vehicle. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alice, thanks so much. Juventus Football Club actually falling some 12% just now. This is on the back of, Italy saying that they will take about 15 points away from the club, but this is because of alleged financial manipulation or how they accounted for player transfers. Coming up, millions mark New Year across Asia as the region celebrates a holiday without COVID restrictions, so we'll have plenty more on that next. And this is Bloomberg.
What do you think of when you think of battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
as we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was a few years ago.
Nobody covers business like Bloomberg, your global business authority.
Christopher Waller says he favors a quarter-point hike at the next meeting, while Klaas Knot sees at least 2 more 50 basis point increases from the ECB. JP Morgan sees chances of an economic downturn falling across markets. The dollar drops with European stocks trading higher. Plus, Olaf Scholz and Emmanuel Macron warn European businesses will need to dramatically boost spending to keep pace with the US and China. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, for the first time in years, millions of people have been able to travel across Asia to celebrate Lunar New Year without restrictive COVID rules. China's abandonment of its zero-COVID policy has given the travel sector a boost, while also raising concerns it could lead to a spike in cases across the region. Well, joining us now is Kei Jin, Associate Professor of Economics at the London School of Economics. Kei, as always, thank you so much for coming on. How do you see the China reopening going?
Well, it's a tricky time. It's one for festive seasons, and the forbidden fruit consumed in Beijing with fireworks blasting off indicates one thing, that some people are ready to move on, to invite, to welcome a new cycle of renewal. On the other hand, there are costs of economic reopening for practically every family. So it is a tricky time, but people are looking forward.
So, can you talk to me a little bit, and what you're extremely good at is really looking at the nuances of reopenings, what this means for urban China, what this means for rural China. Are we going to see many divergences?
Look, in China, there's currently right now not only pent-up demand for consumer spending, but also a pent-up determination for everybody, whether it's the government, the companies, the households, urban areas, rural areas, ready to welcome really a new beginning after years of prolonged lockdowns and economic downturns. The urban inequality, rural inequality has widened because of the pandemic. But government fiscal expansion, which will be a focal point for policymakers, are also aimed at, rebuilding household balance sheets and supporting, especially those who have been hurt during the pandemic, and that includes rural households.
So, Kei, what does pent-up demand look like? Is it goods first? Is it luxury goods, and then on to services?
Well, the Chinese consumers respond slightly differently from let's say, consumers in other countries with reopening. They have built up a lot of saving over the pandemic, but they're not going to just go out and spend on large durables and large amounts of spending, because it's a lot of precautionary saving. There's still a lot of uncertainty in the Chinese economy. Confidence has to rebuild. But in the short term, I can assure you that all families are looking forward to go out there, spend on discretionary services, travel again, and short-term spending will be up. But there is long-term or longer structural problems, structural issues in the economy. It's not as if we just open up the economy that all the economic woes in China would be solved. You have the large debt issues, debt overhang, the fact that companies, those who are still surviving, because billions of them have gone bust over that cycle, look at how do they rebuild their businesses, and the fact is the economy is not really like what it was 10 years ago for China anymore. It's not easy to stimulate the economy as it was when the property was thriving. So these stimulus policies don't work as effectively. There are significant headwinds despite the short-term boost.
So can you give me a sense of what that means actually for some of the policies put in place going forward? So we know that also the economy, policymakers, even the central bank has tried to support the economy. Will that be the main story for 2023 as well?
Well, it's a delicate balance because we need to think about financial fragility as well. And that's on the minds of the Chinese government. How do you, all eyes are now focused on growth. Yes, but once there is significant pickup, they have to turn to maintaining the financial system problems and financial fragility. So I think there's a lot of room for fiscal capacity. There's also more of a lax monetary environment. But again, once the economy normalizes, we can also expect interest rate hikes again, whether it's to fight off potential inflation or to preserve the financial system. So it's a tricky balance. But everybody is aligned to refocus on the economy, and that goes to show that pragmatism and legitimacy ultimately go hand in hand.
Thank you, Katie. Let's also bring Diana Troileva, Chief Economist at Inodo Economics. Diana, we're just talking there with KJ about what kind of economy, I guess, China will see in the next 12 to 18 months. What's growth looking like, Diana?
Well, first, let's see how we get through the Chinese New Year and this largest human migration, which will spread another wave of COVID infections across rural areas where the population is less protected for a variety of reasons. Beyond that, the authorities are intent on getting the economy going from the spring onwards and very much using the old model, if you'd like, credit-fueled, investment-driven expansion. There is some pent-up consumer demand. However, consumer spending has been in the doldrums for a variety of reasons, and reopening or the very strict lockdown restrictions were not necessarily the main one. So over the long term, growth is highly unlikely to reach the pre-pandemic rates. But in the very short term, if we go through this next couple of months all right, and the Chinese Communist Party's gamble pays off in terms of the abrupt and unprepared opening up, then we are looking actually at quite a significant short-term upswing.
So, okay, and thank you, Diana. We'll come back to, of course, this idea of how the economy also changes. Katie, you're in Beijing. How's travel actually looking like? So we understand there are no restrictions. Is everyone going back home? Certainly, there'll be more people going back home than 2022. Do you worry about the COVID situation?
I look out my window and I just see traffic everywhere, traffic like we've never seen before for years. And the airports are full, and people have just said, look, it's been 3 years since I went home to the rural areas or wherever. Everybody's going around. And there's a sense, at least in urban areas, that this wave of pandemic is over. So let's try to enjoy the freedom while we can, and we'll worry about the second wave later. So I do sense that there's this excitement, there's willingness to go out, but work and rebuild and spend. But, we don't know when the next wave is coming, but hopefully the country will be more prepared and there will be less psychological trauma the second time around.
Diana, what can you tell us about soaring unemployment and, maybe concerns about the income outlook?
Although clearly the lockdown sort of zero or dynamic zero COVID policy had driven the economy into the ground. One particular worry is the high rate of unemployment, in particular among the young, those between 16 and 24 years. And this is a key challenge for the party. They have been actually battling with it for the past over a couple of years, including all sorts of measures along the lines of pressurizing state companies to hire interns, even unpaid interns, just to help out with that problem across the younger generation, who are also the ones that kick-started the protests in November, which were largely a surprise to the authorities, even though they managed to get a handle on them very swiftly.
And given all of that, we did see, I think you were saying, Chinese leaders making domestic demand a priority. There have been analysts that have been calling for cash handouts, like we maybe saw in the U.S., to support, some of the policies that they've already put in place. What do you think government support looks like from here until the end of the year?
Well, one of the key differences between Chinese policy and response.
Sorry. Let's do KU first, and then Diana, I'll ask you the same question.
One of the first responses, the key differences between the Chinese and the Western government was that the Chinese focused on supporting the firms in the beginning of the pandemic and not necessarily the households. And now we see a large deterioration of the household balance sheet as well, and a large amount of, a large number of unemployment and precautionary saving, as we mentioned. Now the focus is back on consumers and household welfare. So a lot of the fiscal policy should be, and I think will be, directed towards supporting households, but at the same time giving firms, small and medium-sized companies also a boost as well.
Thank you, Kate. Diana?
That is very much the case in terms of what the authorities are trying to achieve, but of course they don't have full control of households, who for a variety of reasons that continue to be salient have this higher precautionary saving desire. So in order to get quickly the economy off the ground, there is a huge fiscal boost aimed at infrastructure spending as well. More generally, I would argue that removing the dynamic zero COVID has removed what was a short-term constraint on people's ability to simply go out and shop, and of course the psychological impacts of the huge uncertainty, which is likely to continue to cause precautionary saving even after the change in the authorities' pandemic measures. And also, China has not reversed in any shape or form its common prosperity idea, this redistribution of income and wealth, from the rich towards the poor, which is a key reason why the well-off urbanites are not out spending in droves.
Yep. We'll have plenty more, of course, on China throughout the day and the week. Thank you both for joining us. KJ, Associate Professor of Economics at the LSE, and Diana Choi-Leva, Chief Economist at Nodo Economics. Coming up is the bankruptcy of Genesis. One more blow the crypto lending industry can withstand. We'll get more on that next, and this is Bloomberg.
digital-first approach to the future work is where the industry and all companies will be heading.
Let the future work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing? When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird, weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacroix here in London. Now, crypto lending firm Genesis has filed for bankruptcy, becoming the latest to collapse in the aftermath of FTX's swift downfall and last year's rout in digital assets. Is the news the final nail in the coffin for crypto lending? Well, we're now joined by Matteo Dante Peruccio, President International of the digital asset manager Wave Financial. Matteo, thank you so much for joining us. Who's next? Is there a concern that it will take 5-6 more months, if not more, to work our way around this?
Well, thanks, Francine, for having me, and it's nice to hear someone pronounce my name correctly. Thank you. I think, look, I've been a pretty strong advocate for the fact that this is a young industry, and we're going to see, I think, more of this before it's over. But I don't think the terminology of nail in the coffin is the right way to look at this. I think this is a necessary phase for a young industry to go through in order to exit and emerge in a more healthy environment with a sort of a flight to quality. The better players, the more risk managed operators will end up taking over a lot of these distressed players, and I think we'll see a stronger industry emerge from all of this.
But Matteo, what needs to happen for that to be true? We're still seeing a lot of regulators and regulatory bodies not wanting to touch crypto until that's being taken care of. How can you be sure, where the end is, or at least where we're not going to see more bankruptcies or people going under?
Well, it's a great question, but I think we need to contextualize it and make sure that we remember this is today $1 trillion industry. Despite all of the headwinds that we've seen, I don't know of many other industries that would survive so much onslaught as we've seen in the digital asset space. At the same time, I think we have a situation where we have the regulators now paying attention. My hope is that we'll see thoughtful and prudent regulation and not punitive regulation. That's always the risk. Obviously, as more of this plays out, we'll see what's behind the whole Genesis DCG situation. Let's see. But I'm really an optimist. I see more and more. I certainly here in Europe. I'm in Europe, and I see the regulators becoming much more proactive. We have the European community putting in place legislation. We see in MENA, Dubai in particular, leading the way, with Bahrain also putting in legislation. So I think with that regulatory clarity, I think that's going to bring a lot more institutional interest, because once institutions know how this will be treated, how it will be taxed, and considered from a legal perspective, there'll be a greater degree of eagerness to enter into this sector.
But Matteo, how big do you see the crypto crackdown, right, in the next 2 to 3 years? Again, there have been concerns, rightly or wrongly, about money laundering, about tax evasion, about fraud. Some of these concerns, is that what regulations need to tackle first?
Yeah, I think what makes this all a little bit uncharted territory is that as far as I'm aware, in my 35 years in investment management, I'm not really familiar with many financial innovations that started at the retail level and have worked their way up the, let's call it the financial food chain to the institutional. So I think, the regulators are very much focused on the retail end of this, ensuring that retail, and unfortunately, retail investors have been hurt in some of these things like the Genesis, and the Gemini Earn program and so on and so forth, Voyager and others, Celsius. But I think, I really do believe that the regulators will focus on that aspect of it, and I'm actually more bullish on seeing this develop into the institutional, what I call the individual, the wealth management space, where this is a very interesting market segment and asset class, and I think all investors should and will eventually have a degree of exposure to digital assets.
Who, Matteo, do you think will survive this? And again, Genesis differed from a lot of the peers because they didn't market directly to individuals. It's almost like a fund of funds.
Yeah, I mean, that's a very, very good
question.
It's a tough
question.
Yeah. I don't think we've seen, I'm reluctant to make any prognosis because we've seen things that we would never have expected to see. So that's it's a pretty difficult prognosis to make. I can tell you the type of players that will survive. This will be the prudent, risk-managed entities, and I do see a flight to, let's say, a reawakening of the importance of experience, of knowledge, risk management capabilities, and some of those more traditional skill sets that maybe perhaps in the past were undervalued in the digital asset space.
Okay, thank you so much, Matteo, for joining us. Matteo Dante Peruccio, President International of the Digital Asset Manager Wave Financial, joining us this morning. Coming up, Bloomberg has also learned that an activist hedge fund has taken a big stake in Salesforce. So we'll bring you that scoop next. This is Bloomberg.
The innovation agenda is going full speed on mitigation. That's where, there's 100 companies, Breakthrough Energy's funded.
By mitigation, you mean mostly energy. You mean everything to do with energy. You mean generation of energy. You mean batteries. You mean transport. You mean all of the new, and there's some renewables that are already traditional, but more that need to come on. So that's the package that you're talking about mitigation.
Yeah.
Or are you also talking about agriculture as mitigation?
Yeah, so every year of emissions, the world tends to focus on passenger cars and electricity. That's not a third of emissions. And so the focus on the easiest third, now 4% of new cars are electric, so that's the field that we're furthest along. And about 4% of energy generation is wind and solar.
When news breaks, no one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there's a lot else that happened.
But 1 million people are being affected every day, and that's going to rise to 3.7 million by January.
The UK only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Bloomberg Daybreak.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Canada the Close. Welcome to Bloomberg Crypto. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francis here in London. Now, we're just getting some breaking news from the Bundesbank chief. He is Mr. Nagel saying that the ECB will return inflation to the target without causing a recession. We have had a number of central bankers, including Klaas Knot, giving, of course, media interviews in Davos and then again yesterday, and we've also had the French line. So it's unclear at the moment whether they'll be quite aggressive in further rate hikes or whether they're very data dependent. But we'll watch euro dollar for the moment 109.17. Now, activist investor Elliott Management says it has made a substantial investment in software giant Salesforce. Bloomberg understands the stake is worth a multi-billion-dollar sum. The investor is known for seeking board representation and pushing for strategic changes. Well, joining us now is our Bloomberg technology reporter Aggie Cantrell. Aggie, great to speak to you. So, what's the background to Elliott's stake? Why now?
So the background to it is essentially that Salesforce is one of the many parts of the tech sector that was really a pandemic darling. We saw the market cap go up to $300 billion in 2021, and now it's around half of that. So the question is Salesforce, while a company that has performed extremely well during the pandemic, how can it maintain that organic growth going forward? And even if it is still performing better than some of its competitors like SAP and Oracle, Elliott coming on board is probably more of a question of how to make sure that there is a good return on investment going forward for the company's investors.
So should Salesforce be worried? I mean, Elliott, I guess by reputation, is one of the most aggressive shareholders, activist shareholders.
Yes, so there has been worry over these sort of things in the past, especially when Elliott comes on board. But the difference is here is that we've already heard that he's very bullish on the CEO at Salesforce, sees him as a steady hand at the company, and that's going to be crucial going forward. We have seen 5 top executives leave Salesforce since September, including the co-CEO and the founder of Slack, who was brought on board when the company purchased Slack. And so what we're expecting to see going forward is potentially encouragement for potential share buybacks, and also we are not likely to see Salesforce engage in any of these major acquisitions that they did with Slack a couple of years ago.
All right, thanks so much, our Bloomberg technology reporter Aggie Cantrell there in Berlin. Now, we'll have plenty more, of course, on this story throughout the day. Bloomberg Surveillance Early Edition continues in the next hour. Now, this is a picture overall, not only for technology, but for equities are seeing a little bit of a rise. Eurodollar, we just looked at it a couple of minutes ago on the back of the Bundesbank governor, the chief, saying that they will return inflation target without causing a recession. Bloomberg Surveillance Early Edition continues in the next hour. Matt Mueller and Katie Lyons are in New York, and Edwards is here in London, and this is Bloomberg.
somebody says I want to be, and a person has an impact on society, what do you recommend that somebody do to train themselves and to work their way up to be somebody that's impactful?
Well, I think the first thing you've got to believe in something that you really care about. You know, I've been fortunate that over the course of my career, I've come up with things that matter to me, and I've pursued them. You know, the best advice I ever got was from Mike Bloomberg. He said to me at one point, he said, show me somebody who's never lost, and I'll